I think we expect spread widening regardless of whether or not we get a recession. If we get a recession, obviously that will happen more. That's our expectation in liquid markets. And again, big opportunity for alpha there for people to lean in. So just to be clear, we do manage liquid assets as well. At TCW, we have a core plus type mandate. It's the core of people's retirement savings. That's the part of our firm where we would express a macro view. And based on what we've discussed here in that portfolio, we're very liquid, we're conservatively positioned, we're overweight agency MBS, carrying over the index, and we're waiting for one of these events that we just described here, some type of credit event where, again, we can step in, be a liquidity provider, and generate outsized return for clients. We just don't think you're getting compensated now for credit risk. So that answers your question in terms of how we're positioned. And that's what we've done historically at TCW, is wait for those dislocations and lean in. As an example, in 2020, which we alluded to with the pandemic, we put $20 billion of credit to work in a few weeks because that gave us the spread widening opportunity. So we can't tell you exactly, this time will be different. We know that in terms of what the market will do, but the spreads eventually will widen, and you want to be liquid and be able to take advantage of that.
That was my panel with Katie Koch of TCW and Robert O'Leary of Oaktree at the Bloomberg Invest Conference, which just continued today. There was a great panel yesterday with Anne-Marie, with Gary Gensler this afternoon. Our own Danny Berger is also going to be there. I do want to just note, Southwest Air coming out and seeing its revenue of, per available seat mile declining 4 to 4.5% in the second quarter, with available seats up 8 to 9%. Shares are tanking right now on the report that we just got, down almost 11% at one point, 10.4% currently. We'll follow that story in the hour to come. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. Paramount is talking to potential international partners for its streaming TV business. Co-CEO Chris McCarthy told staff a deal could transform the online service and make it profitable. Earlier this month, Paramount's controlling shareholder, Sherry Redstone, turned down a merger offer from Skydance Media. The company also announced it has hired investment bankers to sell certain assets and that the proceeds will be used to reduce debt. All this announced yesterday at a town hall with employees. Julian Assange has arrived back in Australia as a free man. Assange pleaded guilty to leaking national security secrets, ending a 14-year legal drama that once left him imprisoned in the UK and in self-imposed exile in a London embassy. The WikiLeaks founder entered the plea in a U.S. courtroom in the Northern Mariana Islands. The agreement resolves an international fight to prosecute Assange over the leak of U.S. military documents and diplomatic cables starting in 2010. And England advancing to the knockout stages of Euro 2024, but their fans aren't too happy with how they did it. A 0-0 draw with Slovenia was enough for them to top their group, but fans jeered and threw beer cups at the team, which scored just 2 goals in its 3 group matches. Poland's draw with France and Austria's win over the Netherlands means England now has a favorable draw for the knockout rounds, ending up on the opposite side of the draw from tournament favorites Spain, France, Germany, and Portugal. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, the Fed's patient tone.
With significant progress on inflation and the labor market cooling gradually, at some point, it will be appropriate to reduce the level of policy restriction to maintain a healthy balance in the economy.
That's coming up next. This is Bloomberg Surveillance.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Well, Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Growth concerns very much in the forefront. You wouldn't know it based on yesterday and today. If you take a look at, say, I don't know, the NASDAQ 100, if you take a look at the S&P, just basically climbing near record highs, 55.40, up less than a tenth of a percent. But when you can look under the hood, you can see the outperformance very much from big tech and not from some of the other sort of more cyclically sensitive areas. You can see the 10-year yield higher with inflation concerns in the front and crude up 0.9% on geopolitical risks. Under surveillance this morning, the Fed's patient tone.
With significant progress on inflation and the labor market cooling gradually, at some point, it will be appropriate to reduce the level of policy restriction to maintain a healthy balance in the economy. The timing of any such adjustment will depend on how economic data evolve and what they imply for the economic outlook and balance of risks.
Here's the latest. Light on economic data in Fed speak today. We'll just get the new home sales at 10 a.m. Eastern as investors look ahead to Friday's core PCE deflator. Neil Dutta of Macro Renaissance Research, Renaissance Macro, writing this: the Fed needs to get on with it. The rationale for cutting policy rates is quite strong. In short, unemployment is up, core inflation is down. This is why a federal funds rate based on simple monetary policy rules that relate changes to unemployment and inflation to a policy rate suggest cuts now. Neil joins us now. Neil, I love this idea that you're on the same page with Mike Wilson after having quite a bit of divergence for a number of years. Why are you saying just get on with it? And why are you beating the drum right now, saying as loud as you possibly can, you are making a mistake?
Well, so I would say a couple of things. I mean, to me, it's just look at the realized data. You know, the unemployment rate is up. It's up about 60 basis points from its low. So far, it's been rising about 30 basis points every 5 months, which all else equal would imply that it would be around 4.4% by year end. That's higher than where the Fed currently thinks it's going to be. And if you look at core inflation, after some wobbling earlier this year, which I think the Fed is a little bit too concerned about, generally speaking, the trend in inflation is lower. Core PCE inflation is likely to be around 2.5% in May. And, you know, to me, it's thinking about which direction are both of these indicators going over the next 6 months. What's the risk for unemployment? Is it higher or lower from here? I mean, with initial jobless claims rising and the hiring rate low, I think the risk is that the unemployment may rise a little bit, not a lot, but a little bit from here. And with respect to core inflation, there's still a significant amount of disinflation in the pipeline. I mean, Powell's going around worrying about import prices. The dollar's basically running at year-to-date highs. That's going to put downward pressure on imported consumer good prices. We know that things like used car prices have more room to deflate over the summer. New car prices are already declining year over year.
Yeah.
And auto adjacent services like maintenance, repair, motor vehicle insurance, those will continue to come down.
Well, Neil, I just want to break
go ahead.
in. No, I just want to break in here because I understand all of these points and I think that they're valid points, and I would love to talk extensively about each individual one, especially in light of the fact that inflation came in hotter than expected in Canada, came in hotter than expected in Australia, and some people are arguing that some of these indicators are going to reverse into next year, especially if rates come down. I'm thinking of housing in particular. How do you assuage those concerns, especially given the readings we got in Australia as well as Canada?
Well, come on, Lisa. You're cherry picking some of the data. I mean, this is after, I mean, Canada's cutting because the inflation numbers were coming in better than expected a few months ago. So we're going to, I mean, look, I mean, these numbers ebb and flow. You have to have a fundamental framework for why the data will move the way they do. You can't just be a slave to the high frequency numbers as they come in, because that's a recipe for making a mistake. You have to actually have a fundamental framework for how these things will operate. Where's the upward inflation surprise coming from? I mean, if the Fed's cutting, you know, it's interesting, financial conditions, people are making that argument, well, if the Fed eases, financial conditions will ease, growth will pop and so forth. Look at mortgage purchase applications, Lisa. I mean, the fact that rates have been already coming down. If you look at 10-year yields, they've generally been falling. What's that done for purchase applications?
Hold on a second.
Not much of anything. Not much of anything.
Neil, the thing is that when you talk about cherry picking data, you could cherry pick data any which way, and you could tell a different story. It's not as if there's one overarching narrative that dominates. So it seems like you've coalesced around one set of data that is more important to you than, say, all of the perspectives that we're getting from, say, Carnival, with travel picking up, the idea of, you know, certain, you know, retail sales picking up.
The only data that matters, Lisa, is unemployment, U3 unemployment, which is, you know, in a wide body of Fed research as the single best labor market statistics that we have. That was a comment from Janet Yellen back in 2013. Unemployment and core inflation. Those are the indicators that are in the Fed's SEP. You want to talk about Carnival, okay, for every Carnival, there's a pool, okay, fewer home renovations. For every Carnival, there's a Home Depot, okay? You know, so, you know, it's sort of, let's focus on what's in the summary of economic projections. That's ultimately how you back out the Fed's reaction function. In those projections are unemployment, core inflation. You know, you want to talk about economic growth, they look at real GDP as well. Tell me what is the right tail for economic growth has basically been clipped. I don't really see much upside right now. I think growth is running at about 2. Maybe you can talk me into 2.5%. I wouldn't be lighting my hair on fire around recession, but there's not much upside risk.
Well, Neil, let me jump into this, because I think this discussion in itself just really hones in on the point that people can come away with different ideas. Whether or not you think it's the right one is a different discussion, but the Fed is doing just that, Neil. I'm sure you would agree with Mary Daly about the inflection point of unemployment and of the labor market, but for every Daly, there is a Bowman who says that inflation could go higher and that they could be hiking. So in your view, if the Fed is, for some of them, setting rhetoric to yesterday's problem, when we do get cuts, how violent does it look?
Well, I mean, right now, if all we're doing is just waiting on a few more months of inflation data, then it won't look that violent at all. I mean, I think they could probably be talked into a cut in September. Someone like Bowman, if the inflation data continue to sort of do what they did in May through the summer, then I think it'll be very difficult for even the hawks on the committee not to at least make a nod to cutting over the summer. And, you know, folks like Governor Waller, I mean, all they're really doing, I think, is just following the last few months of data. That's kind of setting their tone. So in other words, their rhetoric is somewhat conditional. So if the data changes and their rhetoric quickly changes, then I think things will be okay. Now, if that doesn't happen, it could be a problem. I will say that I do think that, you know, we'll get another soft June, inflation report. That'll be coming out, I think, in a couple of weeks' time. And as that happens, I think the doves on the committee are going to be fighting tooth and nail to make a more sort of meaningful signal at the July FOMC meeting. So that's kind of what I'm looking for.
Neil Dutta of Renaissance Macro. Unfortunately, we're out of time. This has been fun. We should come back and have a longer sort of debate session, because honestly, this is the debate on Wall Street right now. How do you have conviction at a time where everyone's cherry picking data? And frankly, that is the only game in town. Neil Dutta disagrees. He thinks that there is only one game in town. Come on, we could talk about it again. I could talk to you all day. Coming up next, BlackRock's Wei Li, Bloomberg's Josh Wingrove, Jill Carey Hall of Bank of America, and former New York Fed President Bill Dudley at a time of cherry picking. I like cherry picking. That's what we do. There is nothing else right now, given the fact that you could basically have a different story on the same day, Danny, as you were talking about, with pool on one hand, and then you could look at Carnival with everyone cruising around the world and enjoying their croissants. What we're looking at right now in markets is basically a tepid kind of action, at least in equities. You do see a euro weaker in the crude space. Keep an eye on this, up almost at 1%, 0.8%, as geopolitical risk rises.
So linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be, every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Right now, it's soft landing. Great. As long as that remains stable, we can kind of stay in this sort of environment that we're in.
And do you think there's enough evidence at this point for the Fed to start cutting interest rates?
I still only see 1 to 2 cuts this year. I think the Fed still does need to be cautious.
Even though they're not quite at their inflation target, they are probably at the back of their minds thinking, yes, we need to start moving ahead of time.
If they're cutting because growth is really quite strong, but it's just disinflation in the system allows for some scope, then that's a better narrative.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The big question over the last few weeks is big tech dominance a feature or a bug? Welcome back. This is Bloomberg Surveillance for our audience worldwide. Anne-Marie Hordern, Danny Berger, I'm Lisa Abramowitz. As we look at a market trying to find its footing after yesterday, NVIDIA regained pretty much all the losses it had yesterday or the day before yesterday, and yet you saw underperformance under the hood. Raising this question, Danny, is big tech basically a feature or a bug of this market stability?
One thing it has done is it's left positioning extremely full. All the statistics you look at shows that we're very overweight tech. It doesn't necessarily mean that it comes crashing down, but it is a vulnerability. Barclays had this statistic. Household equities are at a record. So people are making some good money. If you own the stock market, maybe the thing that lets it go down, Lisa, is people taking profit to go on their Carnival cruise.
You know, which is what I was highlighting as one note of positivity. Neil did note that he was happy that I highlighted something positive, at least, and if it took...
You sounded bullish.
Yeah, I sounded bullish on earnings of Carnival, of a cruise liner of all things, and that at least made him happy, if that's what it took to counter it. But what he was talking about is really interesting, and basically, he's saying when you look around and what you see is a weakening labor market and a Fed that is late to the game unless they cut right away. He says it's obvious. He says that anyone who pushes back against that is cherry-picking data. My personal view, Anne-Marie, is that we're all cherry picking because you can paint a different narrative with lots of different data. But this is what's making the market right now, with a growing number of people who are saying, actually, it is a weakening in growth that should be the dominant story.
And it felt like he was at this moment on the side of almost Mary Daly, basically feeling like this is an inflection point. He said, basically, you can't be a slave to some of this high-frequency data. You have to focus on two. He said the only two that matter is unemployment, which he says, and especially to his data point, higher than the Fed's by year end, north of 4%, 4.4%, I believe he said, and then also the disinflationary trend. And he said, you have to stick to those two items, and that is it. Ignore everything else. And in that case, he thinks even some of the hawkish members in the Fed could be talked into September being on the timeline.
All right, and maybe we're just talking about 25 or 50 basis points. Maybe we're not talking about a wholesale recalibration of what it looks like to have a neutral rate. That said, there is this very real issue, Danny, especially ahead of some of the housing data that we get later today. What does a 25 or 50 basis point rate cut do to ignite inflation in areas, say, like the housing market?
And it's a point that we discussed with Richard Miller earlier in the week, or last week, when he talked about this idea that it would bring demand back, so prices go up, and you're left with this awkward position. May I cherry pick Canada? That you have a situation like Canada where what they've done is they've lowered rates only to see inflation surprise to the upside. I think that's what policymakers in the US want to avoid, because they did a verbal equivalent of that earlier in the year.
And we could cherry pick Australia as well, with a similar type of situation on hand. In markets, the situation on hand is staring into the sun and doing nothing. That's at least what you're seeing on the index level for the S&P, clawing back almost all of the gains from earlier this morning, basically flat, 55.37, which you could see is euro weakness. I think it's interesting to see that we have broken through that 107 level pretty consistently. That is, we're tracing the lows, the weakest levels that we've seen since last week, amid some of the concerns around the snap election, 106.83. 10-year yields higher because of the cherry picking of Canada, because of the cherry picking of Australia, and what that might mean for global yields and inflationary pressures. 428 rounded up on the 10-year. And crude, I keep watching this. How much do we start to worry about the geopolitical risk with what's going on with Hezbollah, given some of the concerns we've heard from Lloyd Austin, given some of what we're seeing just around the world, up about 0.7%. Coming up this hour, Wei Li of BlackRock saying concentration in tech is a feature, not a flaw. Former New York Fed President Bill Dudley on the risks of the U.S. budget deficit. He cares. And Jill Carey Hall of Bank of America with a bullish long-term outlook for small caps. We begin with our top story. NVIDIA and mega cap tech bouncing back after the chip maker suffered a $430 billion plunge. Wei Li of BlackRock writing this: the concentration in U.S. tech stocks is a feature, not a flaw, of the AI theme. We stay overweight U.S. stocks on a 6 to 12-month tactical horizon and still prefer the AI theme. We like industrials and healthcare as stock gains broaden out. Wei Li joins us now. Wei, wonderful to see you. Let's start with the idea of broadening out. We saw that for a hot second. Every time that big tech kind of fades a little bit, we see the broadening just try to get some more steam. What do you make of that? This idea of the sort of pistons of the market that are sort of operating counter to one another?
The way that we see broadening out is not necessarily coming at the expense of the leaders, right? So we continue to have the overweight in the tech sector, in the likes of NVIDIA, in the likes of Magnificent Seven, because they continue to deliver very strong earnings that are on par with the price appreciation. So we still like that. But we're also starting to see signs of the momentum broadening out, not necessarily at the expense of the leaders giving in to a reversal of the momentum, right? So the reason that we see broadening out of the theme is, if we think about the capex spend that is expected to happen to build the infrastructure, the piping around AI. We're talking about price-insensitive arms race to build AI data centers by all the companies that are flush in cash. Then some of the bottlenecks, as we think about kind of AI data center building out, could create opportunities for excess returns. And this is where we look at the likes of energy, the likes of industrials, the like of materials that are well positioned positioned in this kind of environment of still supply constraint and pretty price insensitive demand.
So this sounds like a very specific broadening out. This isn't, say, Krispy Kreme or, something.
It's not small cap.
Yeah. I mean, my point being that, there are a lot of names that don't necessarily fall within this. Krispy Kreme has a lot of fans and has a McDonald's dealer, a Walmart, I don't remember which, but anyway, that disclaimer aside. My point being here, this isn't tied to the consumer. This isn't something that's speaking to the macroeconomic place. It's more speaking to the sort of trend, the mega trends that you're talking about. Is that a correct way of framing your view?
I think that's very fair. And if you look at the earnings season that recently wrapped up, 8 out of the 11 sectors managed to grow their margins, which gives us confidence that this theme is broadening out. And it's not just public market either, right? It's private market. If we think about kind of the role that infrastructure will have to play to support the build out of AI data center that is needed across sectors, that is a private market play that also allow us to have exposure to early winners of this mega force. So we're talking about a continuum, a combination of public and private markets to position for this mega force playing out that has still a very long runway in our assessment.
So even if those specifically aren't exposed to the consumer, you look at the customers of NVIDIA, which are very concentrated in the hyperscalers, in Meta, in Google, increasingly Apple. But these are companies that are kind of exposed to the cycle. If you think about advertising revenue, if you think about Apple and its ability to start a new cycle with iPhones, so in a roundabout way, could that come back to affect AI? If these companies, for some reason, turn around and say, hey, we don't want to commit as much CapEx, and there's a lot right now that they're committing to building out our AI infrastructure.
No, that's absolutely right. There are caveats to our conviction in the AI theme. One is if the promised CapEx actually do not play out for whatever reason, right? It could be demand is not quite there. It could be that the supply is just not quite there. It could be regulatory reason. And you talked about hyperscalers. They have committed to net zero targets, which in the context of energy constraint may not, something's going to have to give, maybe. So when you bring all of this together, it's possible that the incredible CapEx spend forecast that companies are talking about may not come to fruition, which is one way that the AI theme may not go all the way. But what you just described in terms of the customers of NVIDIA being quite concentrated, this is actually precisely the reason why we also think that the concentrated nature of market at this point is a feature, not a bug of the AI theme. It has been very, very different compared to kind of the dot-com bubble, both in terms of kind of the diversity of the customer base, but also in terms of the extent to which earnings have come through. So we are comfortable with the fact that so far the rally in the US equity market is very concentrated in the names that we actually have liked for a while.
So what will it take for me to be able to buy small caps? What needs to change?
Oh, this is a broader question. I mean, small caps, they are more vulnerable to high for longer in terms of the funding environment, in terms of the rate environment. We still have the view that the Fed will be able to cut this year, 2 cuts likely this year. But as you talked about Canada, you talked about Australia, inflation has not gone away, right? We're still in an environment of labor shortage, net zero transition, creating supply constraint, and still in the environment of persistent inflation. So even as central banks start cutting, they're not going to be able to go all the way that they were able to in the past. Another example, emerging markets. A lot of emerging market central banks, they have been further ahead in the rate cutting cycle, and now they are further kind of ahead as they kind of come to the end of that rate cutting cycle. And what we see is that they are stopping at a higher level compared to pre-pandemic, but they're also stopping at a higher level compared to expectation as they start this rate cut cycle, which I think it's a leaf from the book that developed markets can actually kind of consider as developed market also embark on this rate cutting cycle, which is very unusual.
Do you buy into this narrative, and we see this concentration in the United States, specifically in tech, that a lot of this also is fueled as of late because of some of the political uncertainty around the world, especially in places like Europe?
I think so. Just statistically speaking, the fact that European equities gave back most of their relative outperformance because of the political uncertainty make the U.S. exceptionalism even more pronounced, right? So indeed, it has been partially a result of the political uncertainty and the read across to European equities that make U.S. equities look better. But there are also foundational drivers of this concentrated rally. You know, we're talking about transformations that the likes of which, especially the speed of which we haven't seen in a very long time, if ever. And when we're talking about transformations being driven by a selective kind of concentrated number of names, it's no wonder, in our view, that they are also driving the stock market. So the concentrated nature, in a way, is supported by the drivers of the transformational environment that we're in, and the rest of the world coming under pressure because of political uncertainty further exacerbate that.
Well, just to that point, the idea that maybe the U.S. is doing so well, partly because everyone else is kind of not doing that great. There's this question right now, the Japanese yen just weakened its lowest going back to 1986 versus the dollar. This has been an ongoing trend. This is not because of necessarily economic weakness. This is because of monetary policy, inflation, et cetera, et cetera. A lot of people have been bullish on Japan for a long time, including yourself. Does this make you less bullish to go in on a non-currency hedged basis?
Wow, I would observe that Japanese equity market is negatively correlated with the currency. So a weaker currency potentially can actually create momentum for the exporters within the Japanese equity market. But we still think that over a longer term, at this level, we would still rather own it on an unhedged basis, which is our view at this juncture, but obviously very, very volatile, which is what we have seen so far. Yes, some are banking on intervention coming from the central authorities, but it's going to be very costly, and so far it hasn't really worked. So I think volatility is what we should expect. But for Japan, Japan is actually one of the very few markets where macro is our friend. So here in the US, we're talking about kind of tougher trade-off given the persistent inflationary pressure, central banks having to choose, is it labor market, is it inflation? But in Japan, inflation is coming through in a gradual way, exiting decade-long deflationary mindset, stoking animal spirit, earnings are getting upgraded, and companies are beating their earnings, and the reforms are just getting started. So for all these fundamental reasons, we're overweight. The currency has been really somewhat inconvenient given the volatility that it has created.
Inconvenient looks like 160 in terms of yen, talking about the weakest yen going back to 1986. Wei Li of BlackRock, always wonderful to see you. Thank you so much for being with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. The ECB indicated that investors are reasonable to expect 2 more rate cuts this year. Governing Council member Olli Rehn, who's also the governor of the Bank of Finland, said that officials must ensure inflation returns to 2%, but they shouldn't overly dampen economic activity.
The big picture is that, and our projection is that the European economy is heading for a gradual recovery this year.
Shares of Southwest are falling in the pre-market after the airline cut its revenue forecast for the second quarter. Southwest now expects a decline of as much as 4.5% in revenue per available seat mile, down from previous estimates. The company saying the adjustment was driven by complexities in adapting its revenue management to current booking patterns. And listen up, Disney fans, the Fast Pass may be about to get even faster at Walt Disney World. Starting next month, Disney's Florida theme parks will let visitors reserve a space in line for rides up to a week in advance. Right now, parkgoers can only book a day ahead. The new system will be called Lightning Lane Multi-Pass. Guests at Disney hotels will be able to make 7-day reservations for up to 3 rides. But there is a cost. For example, the Multi-Pass, which allows for 3 reservations, starts at $15. That's your Bloomberg Brief. Lisa?
This is my shocked face that there's an extra cost for something at Disney World. I'm just saying, if anyone's ever been.
You can make a reservation, like you'd go to a restaurant for a ride.
Yeah, well, otherwise.
This would have been useful for last time I was there, because I didn't get to go down Space Mountain. They closed it when I arrived.
How old were you when you went?
No comment.
All right, up next, counting down to the first presidential debate.
The weaknesses in these two candidates are what we're going to learn in the debate. Is Trump going to be more restrained and disciplined in his rhetoric? And is Biden going to bring the energy and the coherence that he did at the State of the Union?
That's coming up next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
A quiet day as we look ahead to housing data. It really ramps up tomorrow with the presidential debate after the bell, as well as, of course, on Friday, that key inflation data under surveillance this morning, counting down to that first presidential debate.
The weaknesses in these two candidates are what we're going to learn in the debate. Is Trump going to be more restrained and disciplined in his rhetoric? And is Biden going to bring the energy and the coherence that he did at the State of the Union, but as we've seen, has been inconsistent in that domain over the last couple of months?
Here's the latest. Just one day until the first presidential debate. President Biden aiming to dispel concerns over his age with a strong performance, while Donald Trump expected to press Biden on inflation, the border, and immigration. The latest poll from Morning Consult showing the candidates in a dead heat at about 44% each. Bloomberg's Josh Wingrove joins us now. Josh, you know, there are a lot of things that people are going to be looking for. Personally, I'm looking for actual policy. Where is the daylight between their policies? And I'm thinking in particular on immigration, given the economic clout. What are we expecting on that front, given some of the rhetoric we've heard from Trump and some of the actions taken by Biden?
Yeah, good morning. I think we're going to see President Biden go after Trump for intervening on that border bill, to name one. You talk about immigration. There was a bipartisan deal in the Senate. It collapsed, and Biden has taken these executive actions, which are just going to be sort of fly traps for legal challenges. But he's going to blame Trump and saying, I'm the one that actually wants to do something on the border. You're going to hear Biden talk about abortion, no doubt. He's campaigning on trying to get Roe v. Wade restored. He, of course, would need to run the table to do that. So, a bit of a tall order, but we'll hear from that. And next year is a tax policy election, or at least next year is a tax policy year after this election, I should say. And so we're going to, I think, hear Biden go after Trump on the reported commitment or interest that he has in lowering the corporate tax rate, for instance. Biden has enjoyed campaigning against Trump's previous tax package, which, of course, many provisions expire next year, namely the individual provisions. And so that one will hang in the air. So I think there will be stuff in there, but the theater side of it is impossible to avoid. I can, sense the excitement in everyone's voice for this big debate. For Biden, the downside, of course, is that if he has a stumble or a moment or a freeze, that will fuel age concerns that have been sort of circulating for Trump. It's if he sort of says something that he's been saying on the campaign trail to his more red meat type base, that might alienate independent voters. And so both campaigns think that the expectations game might work in their favor.
Well, I think part of the reason why not everyone is so excited is because we've been here before. To Wendy Schiller's point, the electorate really knows who these individuals are. But Josh, you recently wrote a story about what Biden's debate prep actually looks like. Take us behind the scenes at Camp David, where he's basically been hunkering down for the past few days.
Yeah, since last week. And, you know, they've been saying, look, he has less time to prepare than he did last time simply because he's the president now. He's got an actual day job. Whereas in 2020, that burden, of course, fell to Trump. And so right now he's sort of up there with a dozen or so aides. His lawyer, Bob Bauer, who played Trump in the 2020 prep, we understand is playing him again this time around. These things kind of start informally, you know, around a fire kind of thing, and then they go to the formal sort of two-podium debate prep. And so that's the stage of obviously that they're at right now. Now, tomorrow, you know, the rules on this are interesting, right? There's no audience, there's no muted mic, or there's the microphones are muted. Between that, of course, Trump has in the past, in particular, talked over both the moderators and his opponent in these debates, and so I guess they're trying to get a handle on that. But Trump's campaign is already working the refs, and they're saying that CNN is going to be biased, and that this is a 3-on-1 debate. They've also spent the last 2 years saying Joe Biden is Sleepy Joe and questioning his mental acuity, and now suddenly are spending the last few days saying what a great debater he is. So it's a lot of to and fro on this one. Trump essentially trying to raise expectations for Biden, and then if he has a good performance, they're also questioning whether there should be drug testing even of the candidates. So the snipping on this one back and forth has been remarkable.
It has been. Also, what I think you see from both these individuals, they're really trying to lower their bar for themselves so they can make sure that they clear it by the end of the night. But there are concerns when you look at polling about Biden's age. How are they going to combat that tomorrow evening specifically?
I think it's a fair bet that they might borrow from their first ad, which sort of began with, look, I'm not, you know, a young guy. And so if they try to sort of wrap their arms around it immediately, that might help. Biden has also said things like, it's not the age of the person, it's the age of their ideas, trying to hit Trump for essentially like an 80s economic policy. Whether this will work, you know, I don't know. The sort of broad question is, can Democrats, that they're asking is like, can Biden come out like the State of the Union, give a good speech, you know, prove that he's up for it, and sort of mitigate any risk? And if so, they're probably in the clear with a pretty good debate. It certainly is possible to come to the conclusion that Biden could have more to lose in this debate than Trump if he does have a moment that sort of feeds those anxieties. I'll note that Biden's been ticking up a little bit in the polls, in particular in some of the swing states. It's been very, very, very minor, but he has a tiny bit of momentum on his side after a lot of polls showing Trump with a bit of a clearer lead. And so this election remains just so tight, it could be just like a handful of states, even just 3 states deciding it. And that's why these things are going to be so closely watched for any sort of one stumble or issue.
Josh, to that point, is one stumble, one issue. Is it enough to convince what's been labeled this time around as the double haters, the disproportionate amount of voters who just don't like either candidate?
I think so, in part because it's only the two of them on stage, right? And a lot of polls have been showing people flirting with the idea of supporting Robert F. Kennedy Jr. or other third-party candidates. And this is sort of a win for Biden in some ways, and for Trump, to just have the two of them up there. Biden's campaign wants to present this as a binary choice, you know, pick one or the other. And they've been saying things like any vote that isn't for Joe Biden is effectively supporting Donald Trump. And so that is one angle here. A lot of polls show in particular sort of younger voters bleeding towards the interest of supporting third-party candidates. And so for them to be able to sort of frame the race as, you know, A or B, pick your slot, I think there'll be excitement about that.
Bloomberg's Josh Wingrove, thank you so much. I want to see the actual attendance or viewers of this debate. I want to see just how viewed it's going to be. MH, I know this has been something people have been talking about, that even though everyone says, oh, we're sick of this, we're double haters, blah, 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 they're still going to be watching.
Yeah, they're going to be watching, if not live, but also what each campaign is going to quickly clip and then get out on. Both these campaigns are on TikTok, Instagram, Twitter, and the likes. Interesting, though, with mute mics. how much back and forth can they really have if you're muted?
I love what Danny says. Or you're going to see one of them trying to scream over the mute.
Definitely.
Turn this thing on.
Yeah, maybe they can reach the other candidate's microphone if they yell out enough.
Oh boy. Well, coming up, former New York Fed President Bill Dudley, not on that, on the U.S. deficit. This is Bloomberg.
Politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
And the gains, the moderate gains have turned to losses as we take a look about 2 hours to go before the opening bell. And you can see S&P futures falling into the red after being in the green for most of early trading, 55.34. Nothing pretty significant about this except for the mix under the hood. NASDAQ 100 up about 0.1%. You can see the Russell 2000 down almost 0.5%, which really raises the question of how concerning is this about the growth prospects for an economy. It doesn't even matter, Danny, at this point, given the fact that, as we just heard from Wei Li, basically, if you are bullish on stocks, you are bullish on an AI trend, independent of any macro trend.
And I love that she was like, this will broaden out because utilities will do well because they need to build up AI infrastructure. Infrastructure does well. So it's interesting to hear people talk about it broadening out, but are like, no, not small caps. Right. No, not cyclicals, though.
Broadening out, very specific broadening out. This is a particular cadre of stocks that will do well. What you're seeing in the bond space is yields marching marginally higher in the United States, especially after what we saw in Canada, as well as Australia. On the 10-year yield, up about 3 basis points, even with 2-year yields coming in just a touch to 4.73. 10-year yields 4.28. 30-year yields coming up also about 3 basis points. Really the two-sided risk here of inflation potentially picking up, as well as potential growth concerns. And then in the currency space, it's fascinating to see the dollar preeminence, regardless of concerns about the fiscal deficit, which we'll get to in just a second, regardless about concerns about political dysfunction, weakening growth, Fed rate cuts, et cetera, et cetera. It is dollar strength across the board. Euro falling below that 107 mark, 106.80. Japanese yen falling, Danny, to its weakest level going back to 1986, crossing through that 160 threshold, raising a question of whether this really does speak to intervention from the officials in Japan or whether that's throwing good money after bad.
Well, we know what's going to happen if they intervene. People who were shorting this thing will just say, oh, lovely, another great level to short the thing at that's even better where I were before. There's some discourse out there that that the BOJ likely won't intervene because we have PCE on Friday. I kind of don't buy that necessarily because we know what PCE is going to be. We know it's going to be slowing, so they could intervene. I think your question is the right one. Does it even work? Does it even matter if they do?
And Lisa, how many times have we been here? The lines in the sand continue to move for the Japanese yen. Until they start to do something when it comes to rates, does any of this intervention matter? Adam Posen was on with Manis earlier this morning. He said unless they come out and did what the Chinese government did basically in 2015, it's not going to be enough. So now what they have to do is basically just continue to manage the decline of the yen.
Which maybe is what they're going to try to do, or maybe they'll just raise rates. Under surveillance this morning, FedEx surging after cost cuts drove better than expected profits in the fourth quarter. The shipping company also pledging to buy back $2.5 billion in stock and hinting at a possible sale of its freight business. Those shares up almost 14%. Danny, what do they have to say about the macro environment?
It's the first thing I did, Lisa. I went to their earnings call, I looked at the transcript, and I said, what did they say? They had multiple analysts ask them, this seems not a macro-driven plan. This seems about cost cuts. They truly avoided the question at every turn. The one thing that they kind of said was that we can adapt, and if the demand environment adapts, we will too. But they so frustratingly didn't say what the actual demand environment was, which I think in a roundabout way comes back to this idea that this is cost cuts. This isn't like, oh, it's a catalyst for the rest of the cyclical market to do well. It's FedEx and a very specific plan to cut costs.
And trying to actually have an idiosyncratic story of success amid an uncertain macro environment without having anything definitive to say on it. The IRS having something definitive to say, saying, I'm sorry, settling a lawsuit and apologizing to Citadel founder Ken Griffin. Griffin sued after his information was included in a data breach, which leaked private data on some of the country's wealthiest taxpayers. AMH, on one hand, you could say this is sort of an interesting gossipy story. On the other, this raises this issue of just data security with the IRS and what concerns there are going forward about future data breaches and what kind of security protocols they have.
Well, that's why they wrote this sincerely apologetic note, because this was an issue about a data breach, which has a number of individuals who were part of that data breach upset as well. And the issue is that the IRS has now punished that individual. This has gone through the legal process, but it is interesting they come out and they said, I'm sorry. He was not looking for any sort of financial wins and gains on this, but the fact of the matter is you're supposed to give confidential information to the IRS. It should remain confidential.
And I'm sorry goes a long way. I mean, don't we all want to just have that validation on some level? Meanwhile, the first of 3 Treasury auctions for this week going off without an issue. That was yesterday's $69 billion of 2-year notes. They were well received ahead of auctions for 5-year and 7-year notes today and tomorrow. Investors are tracking demand for U.S. debt, investors being me, after the Congressional Budget Office boosted its outlook for this year's deficit by 27%. Former New York Fed President Bill Dudley writing this: the U.S. is taking a big risk by running large and chronic fiscal deficits. It's impossible to know when investors will decide that such risks are too much to bear, as the bond vigilantes famously did in the 1990s. When it happens, it tends to be sudden and brutal. Bill joins us now. Bill, I love that you wrote about this. I care very much about the auctions, as everyone knows. I also care about the deficit, even if people say that it doesn't matter. There is this issue of, is it just something people can put in the backs of their minds and say, it hasn't mattered for 30 years. It's not going to probably matter going forward without maybe just a blip here and there. Why should somebody be paying such close attention to this, even if these auctions are going off without a hitch?
reasons. Number one, unsustainable trends always have to come to an end, so we know that this can't go on indefinitely. Number two, the situation is bad and it's probably going to get worse. The Congressional Budget Office assumptions are actually pretty optimistic. They don't have a recession in their forecast over the next 10 years. They assume that the tax cuts that were enacted in 2017 expire, so that flatters the deficit. So things are probably going to be even worse. The other thing I think that's important to recognize here is that when things go bad, they go bad quickly, because if people start to balk and don't want to take on the increased supply of Treasury securities, interest rates go up. That leads to higher debt service costs, that leads to higher deficits. So the feedback loop here is really can be quite vicious. The hard thing is to know timing. It's not clear exactly why the bond market vigilantes arrived exactly when they arrived in the mid-1990s. And it's not clear when they'll arrive this time. But this is not a great trajectory. The other thing I think is important here to realize is that we don't have quite the same demand for treasuries internationally than we did before because of sanctions. The countries that are not friends of the U.S. are trying to diversify their holdings of foreign exchange reserves out of treasuries because they're worried that sanctions could be invoked sometime in the future. So the good news is the dollar is still the reserve currency. The dollar is probably going to be the reserve currency for several decades at least. But that exorbitant privilege that was once called doesn't necessarily have to last forever.
Bill, you raise a fascinating point that I want to dig into. You raise a lot of fascinating points, but one, just to unpack this idea that if you do see any kind of fumble in the demand for treasuries and yields go higher, it becomes almost this spiraling effect that's going to create bigger overall debt servicing costs for the government, which is going to deepen the deficit, which is going to make people even more nervous about buying treasuries. Do we have a sense of what the debt servicing costs look like if rates stay where they are now? Say, if they don't go down, or if you get volatility in rate structure and volatility in inflation, but the Fed is not able to cut rates significantly to levels that we previously saw without igniting true inflation, which calls their hand.
Well, that's one of the big problems we have right now. We're rolling over all the debt that was issued in the last 10, 15 years at very low rates, at much higher rates. And so the debt service costs are going to go up much more rapidly than the total amount of debt. We were very flattered by what happened between 2008 and 2022. The level of debt roughly tripled. Debt service costs went up by something on the order of 20 to 30%. So the situation's not going to reverse. Debt service costs are going to go much faster than the total amount of debt.
Bill, I can't help but wonder if when and if it happens, if it is more brutal than the 90s. And the reason I ask that is we learned the lesson with the UK that part of the turmoil sparked from non-banking entities. It was LDI, it was pension funds. Debt has shifted away into other hands beyond the banks. So if we do get some sort of rapid sell-off in a post-regulatory GFC environment, are banks prepared to help act as a ballast as potentially they once did in those types of sell-offs?
Well, I'm not sure that anybody wants to come into a market and catch the falling knife if things are really bad. I mean, clearly the capacity of the primary dealers to provide support to the Treasury market in size is obviously much diminished relative to the total size of the Treasury market. So the idea that somehow bank dealers can come in and sort of support the market, I think you have to view that as limited. Now, obviously, the primary dealer community has to show up at the auctions. And the Fed is, pretty focused on making sure that none of the auctions fail. But a non-failure of the auction doesn't mean that necessarily the market's subdued. You could see a lot longer tails, higher yields on auctions relative to existing securities, and so things could get out of hand very, very quickly.
I know you said that this is not possible to time, but Bill, do you think this all just translates to any sort of duration appetite right now has a cap just because simply this threat exists?
Well, I think, what the outcome of the election might be relevant here, right? Right now, we don't know who the next president is going to be. And, it's very clear that from published reports that the Trump administration is pretty hostile to the Federal Reserve. So you can imagine a situation where if you had a Trump presidency and it was trying to very much limit the independence of the Fed, people could start to be worried about the inflation outlook, that the Fed would be pressured into sort of monetizing debt. And the reality is when debt levels are really high and rising very quickly, there's lots of temptation to allow higher inflation because higher inflation then devalues the debt. We actually saw that during the pandemic. The surge of inflation that we had during the pandemic actually caused the debt to GDP ratio in the United States to decline despite large budget deficits. So monetizing the debt is sort of always one way out. It's a horrible way out, and you're basically confiscating the value of the debt that people hold through inflation. But that's always a temptation. If people start to worry about that, and I think the worries about that would be much higher under a Trump administration than a Biden administration because of Trump's hostility to the Fed. That could also be an exacerbating factor.
A lot of people talk about what an independent Fed would look like with Trump as presidency because of this Wall Street Journal article. But when it comes to the responsibility of the Federal Reserve, that's delegated by Congress. What could he actually do you think, legally do, that would hurt the independence of the Fed?
Well, I think it's as you're implying, it's a lot harder to change the independence of the Fed than just saying that you want to do it. The governor's terms are staggered. One governor's term tours every 2 years. The Federal Reserve presidents that sit on the Federal Open Market Committee are appointed by their board of directors and the Federal Reserve Board, not by the president, not confirmed by the Senate. So taking control of the Fed is quite difficult. That said, just the mere attempt to take control of the Fed, to diminish the Fed's independence, could be the spark that rattles markets. When it comes to the deficit, do you have thoughts regarding who you think would actually be worse for the fiscal trajectory of the U.S.? I don't think either side has, distinguished themselves, the Trump administration or the Biden administration. I think that the difference between the two, though, I think is if you have a second Biden administration, I think you know what you're getting in terms of policy. So the risk in terms of policy uncertainty is a lot less than under a Trump administration. Trump has proposed some already. The proposals coming out of the Trump side are pretty extreme. Dramatically raising tariffs, cutting income taxes and corporate income taxes. That would be very inflationary in itself. So we had a Trump administration, and if he did what he says he's going to do, and of course there's always a question about that, the economic environment I think would be a lot more volatile and a lot more uncertain.
Bill, before I let you go, since you were on the Fed and you did have a prominent role in the Fed, can you give us a sense of what the conversations are probably like about not 2024 and the path of rates, but the lack of visibility into 2025 given the uncertainty that you just highlighted?
I think the Fed takes the world as it is. So in my experience, they don't worry about election outcomes that are going to happen down the road. They react once the election outcome occurs, and that leads to a set of policies that are relevant for monetary policy. So the Fed's not going to do something, preemptively, or not do something preemptively because of concerns about what the election outcome would be. They'll set the policy based on, what's happening to growth, what's happening to inflation, and I think right now, the market's, trying to figure out what the Fed's going to do next, and it's pretty difficult because it's very much data dependent. Weaker economy, better inflation news, the Fed cuts. Stronger economy, not so good inflation news, the Fed stays on hold. And the reality is the data has been pretty mixed.
Yeah, cherry picking goes back to that conversation we were having earlier. Former New York Fed President Bill Dudley, always wonderful to speak with you. Thank you so much for taking the time. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. A Chinese spacecraft carrying samples collected from the far side of the moon has returned to Earth. The Chang'e 6 landed in Inner Mongolia carrying materials from one of the oldest impact craters in the solar system. This was the first sample return mission to go to the moon's far side, where communications are more difficult because it never faces Earth. The gag order against Donald Trump in his New York hush money case has been lifted for the most part. A judge ruling Trump can now talk about witnesses and jurors, though he is barred from revealing jurors' identities. That gives him more leeway to criticize the proceedings as he campaigns for the White House. The former president had said the gag order prevented him from responding to attacks. Trump and President Biden are due to debate tomorrow night in Atlanta. And New Hampshire is suing TikTok for allegedly misleading users about the safety of its design features and protections for children. The complaint accuses the social media platform of exploiting young users for profit by creating an addictive product that's harmful to their mental health. A spokesperson for TikTok says the app has industry-leading safeguards to support teens as well as parental controls. TikTok is facing a possible ban in the United States if its parent company, ByteDance, does not sell to an American owner. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. I'm going long TikTok's legal bills. Up next, taking risk outside of big tech.
I really do think you need to get the cut figured out because essentially small caps tend to outperform after the cuts happen. So any disappointment we get on that cut narrative is just going to push these stocks right back down.
That's coming up next. This is Bloomberg Surveillance.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
This is Bloomberg.
We keep talking about the shift underneath the hood of the index level, how the outperformance has come from big tech. When you look at the equal weight index, you can see those declines. We really want to dig into that. Under surveillance this morning, taking risk outside of big tech.
I really do think you need to get the cut figured out because essentially small caps tend to outperform after the cuts happen. So any disappointment we get on that cut narrative is just going to push these stocks right back down. The other thing that you really need for small caps to work is an above average economy. I don't like the situation with the Fed, and I don't like the fact that the economic story seems like it's slowing a little bit right now.
Here's the latest. Investors looking for opportunities in small caps on bets the Fed will cut rates this year. Jill Carey Hall of Bank of America Securities writing this. We've been tactically cautious and selective within the Russell 2000 index since April, but sustained outperformance may depend on further disinflation. Bank of America still expects a December rate cut. Jill joins us now. Jill, before we dive into performance, I want to talk about small caps. Some people are saying it's a less relevant index considering how small it is relative to just the big five mega cap stocks. Is this still a referendum, kind of, on the more cyclical aspects of the economy and a sense forward about what we can expect from economic performance?
Mm-hmm. I mean, look, I think there's obviously always some recency bias when the asset class has underperformed for so long. Usually these things run in cycles, about 7 to 10 years, and small caps have outperformed, or underperformed rather, for the last 10 years. So, you know, I think based on where valuations are, which tend to matter more for long-term investing, this would argue that we could see a better decade for small caps. I think they are still a good diversifier when you look at, you know, their
diversification properties relative to other indices out there. And I do think they're still, even though they could struggle near term, I still think they are an economically sensitive area where if you want to get, GDP sensitivity, CapEx sensitivity, if we want to see something that could benefit from reshoring, peak globalization, I think a lot of domestic SMIDs still have opportunities if we think about the next several years.
One of the anxieties underpinning the underperformance, at least of late, is that these companies are more leveraged. And they're kind of damned if you do and damned if you don't. If rates stay high because of economic strength, they're going to struggle based on their debt structures. If they go lower because of economic weakness, they're going to struggle because of the weakness that they're leveraged to. How do you get around that?
Right. I think, like you said, the size segment may struggle near term because of refinancing risk. So if we're in this uncertain environment about rates remaining higher for longer, and, granted, the latest inflation print was a step in the right direction, but I think the Fed and investors want to see more progress on that to feel comfortable that we'll see a cutting cycle because, about half of the debt in the Russell 2000s either short-term or floating rate. So over the next several years, you start to see those maturities come due. I think a lot of investors are also focused on the profit cycle because usually small caps outperform when profits growth bottoms and picks up, and that's what consensus is expecting this year. But revisions have still been negative, and that profits recovery has kind of gotten pushed out, so it's very back-end loaded. So I think, if we see confirmation that that's actually looking like it's a reality and those expectations aren't too optimistic, then combined with, more easing of inflation, it could be potentially a better year end for the index. But for now, I think you definitely want to be selective and focus on pockets of small caps that are less exposed to those risks.
Okay, so what are those pockets? Where can you find the actual value that can gain when everything else seems that gravity is really weighing on it?
Right. I mean, I think since the macro story hasn't changed, we've still seen, GDP growth was generally better than expected. When you think about the beginning of the year, or even last year when everyone was expecting a recession, you've seen manufacturing recovery. So I think you want to focus on the areas that are more exposed to, economic cycle recovery, CapEx spending, areas that have less refinancing risk. So, being active and selective, focusing on, does the company I'm looking at have a lot of debt or short-term or floating rate debt, and screening those out, and then focusing on, quality cyclicals, stocks that are not going to be sensitive to interest rates. So from a sector perspective, I think, some of the energy, industrials, materials, these sectors tend to have less refinancing risk relative to sectors like real estate and tech within small caps that are more at risk there. And focusing on, cyclicals, quality, value, I think are all themes that could work near term.
I mean, value, though, is one of these themes that has been just crushed this year. I mean, if you were to trade on the theme that because it's a low valuation, it's going to pick up at some point, it's been really difficult. And this gets the argument that some people like Cliff Asness talked about yesterday at Bloomberg Invest, David Einhorn has talked about this, that something is different about this market, that something's fundamentally broken, and valuable companies from a fundamental basis aren't getting rewarded anymore. Do you share any of that concern?
Well, I think, again, a lot of these things happen in cycles. So we were in an environment for many years where there was, low profits growth, low economic growth. So growth as a style was rewarded. But, now we've seen as economic growth and profits growth picks up, that's an environment that tends to be one where you don't need to pay up for expensive growth if growth is becoming more abundant. So I think, you don't want to buy risky value. You still want to stay away from the non-profitable companies within small caps. Fortunately, the value benchmark has fewer of those than the growth benchmark does right now. So I think focusing on quality value rather than risky value, and having those screens for leverage or for rate sensitivity makes sense. So I think it'll be a stock picker's market. And at B of A, our analysts cover about 1,000 small and mid cap stocks. So I think there's still lots of opportunities out there, even though as mentioned, the asset class has gotten smaller.
A lot of analysts come on and they talk about maybe now it's the summer of malaise, hunker down because of the U.S. election. When you look at small caps, which ones are most sensitive to November?
Well, I think overall, we've seen that volatility, the VIX, which has been very low, tends to pick up, kind of consistently rise from July to November of election years. So, I think that's just another reason that, in addition to near-term uncertainty around inflation and the Fed and the profit cycle, that, small caps, at least in terms of the Russell 2000 index, could be challenged near-term because typically when the VIX rises, that's an environment where the Russell 2 underperforms the large cap index.
Jill Carey Hall of Bank of America, thank you so much for being with us. We really appreciate it. And we have been talking about some spread widening in the credit sphere. That seems to have retrenched, actually, and gone back and become a rally because people can't get enough. And it's been in this push-pull kind of sphere for quite a while where people aren't sure exactly whether it's truly weakening or actually that's a buying opportunity.
And I loved you talk to Katie Koch about this because you look at that and you're logically like, there's not enough spread here to account for the risk. Something is amiss, but there's just so much demand and so much issuance. It's continuing at pace. But again, as she said, there is this idea, at some point, it's got to break.
Yeah, we were thinking that going into this period that there was so much debt issued at such low rates that when you had to refinance at higher rates, oh my goodness, it was going to be so rough. And yet you have all these investors that are tied to making sure these companies keep going so they don't take losses, et cetera, et cetera. Coming up next hour, less of that, more of this. Chris Harvey of Wells Fargo, Dan Ives of Wedbush, of course, the bull on Apple, talking about the path ahead, Jason Draho of UBS, and Florida Urici of T. Rowe Price, and why she thinks people are overly sanguine about how quickly the Fed could potentially cut. Right now in markets, you do see yields in the long end marginally higher after what we saw in Australia. 10-year yields up 4 basis points, 4.29.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build. So it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
The summer is going to be a lot of push-pull on the markets. People are having trouble finding conviction in a trade at the moment.
We are in an era of stories, more so than we've been in a very long time.
Momentum has worked very well. Momentum kind of feeds on itself. I think there's more room to the downside on the momentum stocks.
There's a cautious undertone to this market. Over the longer term, it's still going to be earnings that drive the markets higher.
The boat that's tilting back and forth. People are running to different sides of the boat can actually remain fairly stable.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
A lack of conviction, but lots of stories. Welcome back. This is Bloomberg Surveillance for our audience worldwide. Anne-Marie Hordern, Danny Berger, I'm Lisa Abramowitz. As we look at a range-bound market that lacks conviction with a lot of stories that people are talking about, Steve Eisman among them, not only Marvel Comics, but also with NVIDIA. This is the issue right now. Even people who were bullish 2 months ago have to either revise upward their projections for the S&P targets, Danny, or else they're suddenly bearish because the index has gotten ahead of them.
I mean, the irony is you can be bearish under the surface and be right and upgrade your target at the same time because you just have this behemoth of a trade, NVIDIA momentum carrying us ahead. Dan Curtis, one of our producers, pointed this out. Only 113 S&P 500 members rose yesterday. That is the second weakest breath behind a rally of the century.
Yeah, and that's what we heard from Mike Wilson, right? That we're seeing the lowest breath in the market going back to 1965. Emery, this raises this question of which story should we cherry pick? I mean, this is sort of Neil Dutta saying, Lisa, you are cherry picking things. We all are cherry picking things because the data is contradicting itself. Do we cherry pick pool and the fact that people aren't getting pools? Do we cherry pick Carnival and say people are cruising around? Do we cherry pick Disney and the fact that people are willing to pay $15 to make reservations at rides?
Well, to Neil's point, when you were sounding very bullish there, he's like, for every carnival, there's a pool. So to Steve Eisman's point, everything is about stories. But Neil is saying, and almost Steve Eisman is saying, have a thesis and ignore everything else. Steve Eisman says nothing matters. The election doesn't matter. The Fed doesn't matter. Buy NVIDIA. When it's down, buy more. Neil Dutta's point, in terms of maybe an inflection point, is the only two things that really matter for the Fed when push comes to shove is the unemployment rate and what's going on with inflation.
Yeah, you can say that as much as you want, but for every daily, there is a Bowman. It's not even agreement on the Fed. So, I mean, when we're looking for signals, you can't trust corporates because they're saying something different. You can't trust the data because that's saying something different. And oh, look, the FOMC is also saying something different.
So let's tell some stories based on what's going on in the market. Not a lot. Basically, you're looking at an S&P basically flat, flirting with gains and losses throughout the morning. 55.35. The euro, that's a story, and the story is weaker. And we've seen that pretty consistently, clawing back some of the losses from earlier this morning. Nonetheless, south of 107 in the face of that French election, the first round of which starts on Sunday. 10-year yields. This story actually getting my attention, the cherry picking of Australia and Canada with inflation coming in hotter than expected, raising questions about just how much onward inflation momentum there is in the global economy. 428.65 on that 10-year. And here's another story. Crude inventories going down. Also, this idea of geopolitical risk, and that means crude prices higher, although we're tracing some of the gains from earlier this morning, up 0.6% at $81.30. Coming up this hour, Chris Harvey of Wells Fargo as stocks recover after NVIDIA's rout. Dan Ives of Wedbush lifting his Rivian price target on the back of its $5 billion pact with VW. And Blarini Urici of T. Rowe Price on why the bar for a September rate cut is just so high. We begin with our top story, a tech turnaround lifting stocks, NVIDIA recovering after a $430 billion rout that seems like a blink ago, given the fact that we've retraced almost all of it. Meanwhile, that has helped stocks snap a 3-day losing streak. Chris Harvey of Wells Fargo saying this: we're approaching our 55.35 S&P price target, but no change there. We remain in a growth at the right price camp. GARP. Momentum may bend, but won't break in the near term. Macro factors are not where they need to be for a point of inflection. Until ultimately, we think it still needs to get worse before it gets better. Chris joins us now. Gets worse before it gets better. What does that mean?
So what that means is I think you just had on a small cap analyst or a small cap strategist, right? And people are asking us, when does the breath change? When does things broaden out? And what we think is it has to get worse before it gets better. In other words, you need the economy to slow down. You need people to see the economy slowing down. You need the consumer to pause a little bit more, and then you have to pull Fed fund expectations forward. You need them to start cutting sooner and a lot more aggressively. And until you see that, there's no rotation.
In the meantime, is this basically what we can expect? Is NVIDIA kind of goes, pulls back, goes, and everything else just kind of lags behind in a malaise of uncertainty?
So I can't speak to NVIDIA, but I can speak to momentum, right? And it is part of the momentum trade. That momentum trade is not breaking. So if you're part of that momentum trade, great. You'll continue to do this. You'll bend, but you won't break, right? Because at the end of the day, there's only a select few things that are working. Your AI adjacent, and that's pretty much it. The economy, as far as we see it, isn't great, and the consumer is very, very selective. So if you're tied to that, hey, Mo's going to work. Mo has been working. It's not a straight line up, but until we get the Fed changing, pulling expectations forward, and the only way they do that is things getting worse, you're not going to see that rotation.
It's all about the big Mo, certainly, Chris. You were also right about ETFs, and you write about XLK, this tech ETF. Right. It got a lot of attention last week because of a rebalancing. There were some weird flows there that people said, oh, there's record flows into tech. Oh, maybe not. Maybe this is a technical thing. So I was looking at this, and I saw that ETF launches are 52% above the record pace. And it's being led by structured and exotic products. So when you look at an XLK rebalancing, you look at all these ETFs, are there some distortions we're not fully appreciating right now?
So XLK and NVIDIA changing. So there's a bunch of things we can talk about. One is back in 2021. So a while ago, we were high in the street. We were high in the street in 2021. And what we talked about is things like Staples Center becoming crypto.com, where the heat play, FTX, so on and so forth. And that's kind of an anecdotal signal, right? NVIDIA becoming 20%, flip-flopping with Apple. Is that an anecdotal signal that we need to pay attention to? I'm not sure. The flows, what you have to also remember is, and I'm not an expert on this, there are some tax issues and some tax arbitrage issues that you see with ETFs that can cause some outsized flows. And then I think with some of these smaller structured ETFs, what you're seeing is people just want very specific. They don't want to trade a stock. They want to trade a return distribution, or they want to return a type of style or something to that effect. And so you're seeing these things pop up to fit that need.
I heard it called boomer candy. Our BI analyst called it that this is just the boomers want it for retirement. Okay, so maybe not a threat. But when you talk about momentum, what comes to my mind are just CTAs and trend followers, the kind of bots that grab onto these things. Is that a concern at all?
Everything's a concern. So here's what we're concerned with right now. Credit spreads are widening out for the first time in a while. That's a concern. What's a concern is everyone is now bullish, right? It's hard to find somebody who's not bullish. The third thing that's a concern is there's no volatility, there's no uncertainty in the market. That's really strange. And the last thing, the most important thing that we're really worried about is you haven't been penalized for being wrong, right? People thought you were going to see the Fed cut 6, 7, 8 times this year, right? What was the penalty? And we haven't seen one cut. Maybe we'll see a cut later this year. What was the penalty for that? Double-digit equity gains. So when that occurs, you get overconfidence, you get people that think they can walk on water, and they start to do things that are uneconomic longer term. So this is a time, this is a period in the market where we think systemic risk rises, where people put more and more risk in the portfolio because they have to. And ultimately, that doesn't work out well longer term, but in the near term, we're not close to the top.
Okay, just trying to put this all together, and actually a viewer just wrote in and frankly read my mind, so thank you, Mark, because frankly there's this question of, if it has to get worse before it gets better in terms of broadening out, why are you still calling for basically gains or flat S&P index levels?
So, okay, so when you're in an environment where the economy isn't great, that's a perfect environment for, so what do you want for momentum to work? You want the status quo to stay, right? Until you see the Fed pulling Fed fund expectations forward, that's going to continue to work. So that's actually still okay for the broader market. If you're small cap or you're mid cap, that's not a great place to be, right? Small cap or mid cap are going to have a really difficult time when we see, if I'm right, when we're seeing the economy slow down, when we're seeing the Fed pull expectations. Longer term, it'll be good, but in the short term, you still have this momentum type market. You still have this growth market. And as we've seen all year long, you don't need a lot of breath. You just need a couple stocks to work.
So in other words, if the data weakens, you could still see index level gains, even though there is this weakening that the Fed could respond to that could further propel stocks higher after that.
Large cap and uber cap gains, not mid cap, not small cap gains. And you would see growth outperform value.
You say in your note, backed by popular demand. I want to move to the politics of this because you added a new fun chart. You are tracking Trump to the S&P 500, and now you're tracking Biden to the 10-year yield. What are they telling you?
I don't like to talk about politics too much. So a couple things.
You have two good charts, though. You really outline and highlight in your notes.
Yeah, we kind of stumbled upon those. So a couple things, backing up a little bit. What we do like to talk about with politics is one, if the GOP takes the Senate, right, and it does, in our estimation, it looks like it's a more likely outcome than not. Those 2-year returns to the equity market are much better. And we think that's because the GOP is a little bit more business, economy focused. They're a little less focused on regulation, and M&A has been held up by regulation. As far as the presidential election, we still think it's a coin toss, but it is really interesting. A couple things. If you look globally, if you're an incumbent, it hasn't been a great situation, right? It's been very, very difficult if you've been an incumbent. We stumbled upon this chart with the probability of Trump winning in the S&P 500, and what we said is, hey, this is an interesting chart. It's not causality, but as we talk to people, they do think that Trump is more market-friendly than Biden. And so that's what maybe the market's picking up on. It could just be a sheer and utter coincidence.
When you say the Senate, and I know you don't want to go too much into politics, but if you say the Senate is going to go Republican and they're, more loose with regulation, can you really say that when you have like a Senator J.D. Vance, who the only person he thinks that is effective in this Biden administration is Lena Khan?
Well,
isn't this like the difficulty of the Republican Party right now from a business point of view?
It's the difficulty with politics in general, right? At the end of the day, what we do is we think about this in totality. We think about this in the aggregate. And their philosophy, their base is to be lighter or easier on regulation. The situation with M&A over the last couple of years has been very difficult. We had a very difficult situation with M&A. A lot of that is around regulation and enforcement. And if you do see the Senate go GOP, we think to some degree that eases up.
Chris, I love this because I love talking to you always, but I also love how everybody tries to explain why they're forced to talk about politics because their clients force them to talk about politics, but have actually no enthusiasm whatsoever about talking about politics.
To be fair, he put two charts in.
I understand. That's because clients want to know about it.
You put the bait out there for me.
But it's true. Am I wrong? It's because clients are asking.
We're pointing things out.
Okay.
Right? We don't like to opine or pontificate on. It's fraught with a lot of risk, but you put those charts out, and it was an interesting chart. You do look at the incumbents globally and say, wow, that's not such a great situation. But more importantly, when the GOP controls the Senate, those are better returns to the equity market, and that does, to a certain degree, make sense.
You put the charts out and then tiptoe away and say, make of it what you will. Chris Harvey of Wells Fargo, you're a good sport. Thank you so much for being with us. Let's get to an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. We are staying on politics here in New York. Democrat George Latimer defeated incumbent Congressman Jamal Bowman in the most expensive congressional primary in U.S. history. Latimer entered the race as Westchester County's top elected official and defeated Bowman by a double-digit margin. Bowman is now the first member of a progressive group of representatives known as the Squad to lose re-election. Bowman had garnered controversy for his response to the October 7th attack on Israel and for an incident at the Capitol where he pulled a fire alarm during a session. Shares of FedEx surging in the pre-market. The company announced fourth quarter earnings that beat Wall Street estimates and said it would buy back $2.5 billion of its stock over the next year. The better-than-expected results are a sign the company's sweeping reorganization and cost-cutting plans are taking hold. FedEx also hinted at a possible divestiture of its freight business, saying it's assessing the unit's place in the company's portfolio. And Paramount is talking to potential international partners for its streaming TV business. Co-CEO Chris McCarthy told staff a deal could transform the online service and make it profitable. Earlier this month, Paramount's controlling shareholder Sherry Redstone turned down a merger offer from Skydance Media. The company also announced it has hired investment bankers to sell certain assets and that the proceeds will be used to reduce debt. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the morning calls Dan Ives of Wedbush on Rivian's growth story as it enters into a $5 billion pact with VW. That's coming up next. This is Bloomberg.
or other authorities.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Time now for the morning calls. First up, JP Morgan upgrading FedEx to overweight with a price target of $359. The analyst highlighting the shipping giant's decision to explore possible divestment of its freight unit. Don't call it related to the macro cycle. Next up, Citi raising its price target on Carnival Cruise Lines to $22. The analyst noting the company's, quote, enduring price power amid the cruise line industry's, quote, post-COVID phase. And finally, Dan Ives on Wedbush raising his price target on Rivian to $20, maintaining an outperform rating. He cites the EV newcomer's $5 billion pact with Volkswagen as a game changer for the Rivian story. And in fairness, I'm not sure if we can call Rivian a newcomer, maybe a midcomer. Dan joins us now. Dan, I want to just get started with why you think this is a beneficial deal for Volkswagen. I understand why it might be beneficial for Rivian. Why does this make sense all around?
Well, this is the horse that they're betting on. And it's an established EV player that's just had capital issues and supply issues. Huge vote of confidence for RJ and Rivian to get this VW capital in. And I think it's just the start. I mean, this is really ultimately what could be more and more of a partnership that changes the game for Rivian, takes the bear case, the Uber bear case off the table.
Dan, what about the awkward fact that VW has an electric car, a truck that they've invested in? They have Scout. Are they not going to start cannibalizing themselves?
Look, I think for them, it's ripping the Band-Aid off. It's recognizing if they're betting on someone, Rivian, they needed someone. And ultimately, even as Amazon sort of step back a bit, and for VW, it's a huge bet. And look, they could still have some success on some of their own ventures. But in terms of what Rivian's built, I mean, I think this is the start of just a broader partnership, as well as also gets Rivian into Europe. And we'll see in terms of potentially new models that they could come out with, potentially VW branded. So it's a huge win for both. And I think for investors, a major sigh of relief.
I am wondering, Dan, if this is the beginning of some sort of tie-up cycle. If we end up seeing more of these types of partnerships at a time where there's really fierce competition, there are questions about short-term demand, maybe not long-term demand, and it's going to be a question of size and market share more than, say, some new slow innovation that maybe can move the needle over the long term, but not the short.
Yeah, it's almost like an eighth grade prom. I mean, on one side...
Never changed, Dan.
Yeah, on one side, you have these EV players that need capital. On the other side, you have the traditional OEMs that maybe have been later to the game, but have the capital. Competition's building. You have Musk and Tesla top of the mountain, along with BYD and others in China. And it just takes one, right? And I think this is going to be the start, tip of the iceberg to where I think this is all going.
Dan, the industry as a whole, though, is facing an uphill battle. Ford cutting spending on EVs, $12 billion, delaying a new battery power model in factories. GM recently acknowledged it will take, quote, decades for the EV market to develop. You see mainstream buyers reluctant to go in and buy EVs. So why do you think this makes so much sense? Because that is not the direction of the market right now.
Yeah, it's a great point, but it's similar like what Ferrari's doing as well. It's making just a bet. It's hedging their bets in terms of where this EV hybrid world's going. No doubt, it's been ever so like uphill battle for EVs. We've seen across the many have gone by, over the cliff, but the stronger are going to get stronger. And when you look at where Tesla is, you look at BYD, look what's happened in Detroit. I mean, essentially 313 area codes betting on hybrids now. That's been the smart strategy, but it's another reason why GM stock's doing what it's doing. It's going to be this combo. EVs, clearly, the dream scenario is off the table, but you will see more and more EVs on the road, and that's essentially the bets they're making.
And there's a bet, and I love, by the way, your phrasing. It's just wonderful. I'm thinking about the awkward prom dates that are going to be taking place between some of the European companies, in particular, as they look to compete with China. I wonder how much the onus is going to be on some of those German manufacturers in particular, especially as maybe there are going to be EV tariffs coming from China into Europe, but not like in the US, where it's basically putting up the wall and saying, don't even try it.
Yeah, there's going to be some, I mean, going back to that, some awesome, you know, and some potentially awkward prom pictures that we're going to be seeing there. Because look, for in Germany and what we're seeing in Europe, I mean, Chinese are coming. They're late to the game on EVs. But more and more, it's going to be JVs, partnerships. That's what we're going to be seeing. Because it is a mini Game of Thrones playing out, despite clearly some of the bloom coming off the rose and broader EVs. And just names like Tesla, names like BYD, there's going to get more and more aggressive globally.
Well, now all I'm thinking is, like, who's in the red wedding scene and what absolutely gets slashed when that happens. So Dan, is that what we're moving towards, a world where European autos, if they want to have EVs, they can't stand alone? Is that kind of what you're saying, that alone they can't fight off the competition from China, and VW is one of many that we'll see, of Mercedes moving this way, of you name it, European auto manufacturer, that they need to find a buddy, they need to find a date to the prom?
Yeah, and in terms of that, I think VW, what they're doing here, that's a shot across the bow. Now, Mercedes, I think, stands in stronger position than others, but it is going to cause others to sort of go down that path. Because if you're late to the game there, then you get closed out. And I think that's sort of where this is going. Rivian was clearly, that was the perfect situation. They needed something. VW called. I mean, that was, I think, just a massive almost coup for Rivian. But there's going to be others. But others are going to go, they're going to fall off the cliff from an EV perspective. They can't raise capital. And I think that's why you're going to see, it's almost, the stronger get stronger, but others are definitely going to fall away.
Dan, you know, as you're talking, we're putting up a chart of just the year-to-date losses on a lot of these names. Tesla, Rivian, others as well, Lucid Group in particular. I'm just wondering at what point you can really sort of leave some of these for dead. Whether it's Lucid, Rivian, you're saying, has gotten a shot in the arm, but some of these have to fail, right? I mean, who do you think could potentially either fail or get subsumed?
Look, I mean, Lucid, that's not a roses and champagne situation. I mean, look, we saw what happened with Fisker. There's a lot of smaller other players. But the reality is, like, when we talk about strong getting stronger, look, Tesla, this is just what I view as an air pocket period to just a massive growth renaissance on the horizon, and especially when we think where AI and FSD and everything else going. For Rivian, they're going to be a longer-term player. And I think you're going to see more and more in Detroit, in Europe, betting on some of these. But then others are, if they're not successful in the next 6-12 months, it's really going to be messy. But from an investor perspective, that's why. Like, you bet on AI revolution. It's 95 moment. Tech continues to be the play. EVs, it's 9 p.m. in that AI party going to 4 a.m. And EVs, they're down the block being like, what about us?
Dan Ives of Wedbush, thank you so much for being with us. Always fun, always a pleasure. Coming up next, Jason Draho of UBS and Blorino Urici of T. Rowe Price as we parse out the growth versus slowdown story. 8th grade prom, awkward prom pictures. This question of, is that really what we're talking about with these names?
Well, the Bloomberg opinion columnist Chris Bryant really says it's more than just 8th grade prom. It's that Rivian is embraced by, quote, his words, a needy German sugar daddy.
I think we just need to put an X on metaphors for a while. I think we're done.
I think we ended. I think we can go back to look at that S&P 500, which is entirely range bound and completely flat. Right now, you are seeing yields marginally higher on the long end. This is Bloomberg.
world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Not a lot of data today. We do get some housing data at a time where that's one of the biggest mysteries. We've been talking about it pretty consistently. What does a cut in the Fed funds rate do to reignite potential demand for mortgages? In markets, it is pretty quiet today as people await the key data of the week, which is Thursday, actually tomorrow, the debate between Biden and Trump. And then on Friday, that core PCE data plus personal spending and income. Meanwhile, across the board, losses. S&P future losses are deepening, down about 0.1%. NASDAQ futures basically flat, and the Russell 2000 underperforming as it has all of this time, which is really interesting, Danny. Just to stick with this sort of, teenage theme that we've been talking about with proms, et cetera, there's an angst under the surface. And this is what we've been talking about. I mean, we have people on like Chris Harvey, who doesn't sound particularly positive, but says we could still see gains on the index level.
Something he said really worried me, and it's that more people are taking risk in their portfolio because the only thing they can hold is NVIDIA. Steve Eisman was talking about this yesterday, that he owns a lot of NVIDIA, and I asked him if he buyed the dip, and he was essentially like, we own so much, we're already violating risk parameters. Usually that's a problem when people start violating things like that, when they start throwing out the window tried and true methods of portfolio construction. It usually doesn't end well, this movie.
That said, if they don't, they lag behind and they're penalized by their investors and by their managers. Meanwhile, you can see in the bond space, 2 10s and 30s, you can see yields marginally higher on the longer end, lower on the front end, 473 for the 2-year, 10-year yields, 428, 30, 441, and this comes in the heels of higher than expected inflation in Australia, in Canada. Questions around just whether we really see an ongoing inflation beast that has yet to be slayed. In the currency space, this to me is probably the most interesting move right now in markets, and that is the yen being the weakest versus the dollar going back to 1986. Coming at a time where people are wondering about intervention. Amber, you talked about this earlier, the idea that we were talking about intervention at 140, then 150. Now we're at 160.36 for the U.S. dollar versus the yen. And one company portfolio. Danny, to me, this is perhaps, you would think on the surface, the wrong kind of upside surprise. It is coming with cost cuts. You did the math. You looked at the hood. What is the macro call? There is none, at least not that's identifiable.
Almost as if they were trying to avoid it, Lisa, because they straight up got asked, what is the macro environment you're dealing with? And they basically said, yeah, we can adapt to any macro environment. They didn't ask the question. One thing I did see in their call that is kind of macro-y, that's interesting, is they're benefiting from nearshoring. I thought this was really interesting. They talked about manufacturing moving to Mexico and that they can take advantage of it. I mean, they didn't say the quiet part out loud that what's actually happening is that we're not bringing goods in from China anymore, hence why that's going to Mexico, but they've prepared themselves for that, and that at least was interesting.
Yeah, but otherwise they're not going to really comment on the macro economy, and perhaps the reason why is because it's impossible to do so, including for businesses. Volkswagen, meanwhile, is revving up its electric vehicle operations with a $5 billion plan to develop battery-powered vehicles with Rivian. The deal would be a financial lifeline for Rivian, whose shares are down almost 50% year to date, and give VW a way to expand its U.S. manufacturing footprint. A lot to say with this. We were just talking to Dan Ives about this, but Anne-Marie, I wonder how much this is also triggered by this idea that German auto manufacturers in particular need to find some exit strategies with the onslaught potentially of Chinese EVs.
Right, because these German manufacturers might be the ones that get caught in the crossfires when it comes to a trade war between China and the EU, even though there was some interesting points this week about China and the European Union are going to start trying to manage this. There's going to be discussions about this. What surprises me so much, to Dan Ives' point, yes, it's a full-on lifeline for Rivian, but they're going in the opposite direction of the industry. Ford, GM, they're all ratcheting back because the demand is not there right now. But maybe VW, thanks to your point, you got to make a move now.
You got to get some sort of foothold, at least in one market that's insulated from some of those Chinese EVs. Meanwhile, Fed Governor Lisa Cook saying it will be appropriate to cut rates, quote, at some point, adding that she expects inflation to gradually improve this year before more rapid progress in 2025. Investors looking ahead to the Fed's preferred inflation gauge. Jason Draho of UBS, alongside Blurina Urici of T. Rowe Price. Blurina, I want to start with you. You had a call basically saying people are overly sanguine about how quickly the Fed could cut rates. Why do you say that?
Well, I think when I look at the U.S. economy, I don't see a lot of reason for concern and for a sharp deceleration. And then on the inflation side, we have had some progress, but the Fed chair has made it very clear that they have a different reaction function to, say, the ECB. For Powell, the first cut is consequential. They want to have confidence that by the time they cut, they will deliver a series of them rather than one and done and see how the economy plays out. So in this context, I don't see the rush. I see them as playing with this patient approach, getting more confidence on inflation and getting a clearer signal that the economy is really decelerating, which I don't see right now in the data.
Jason, do you agree?
I would agree. I think the markets are pretty sanguine about it because the Fed's been able to wait because the economy's strong. You think about where we were in mid-January. The market was pricing nearly 7 cuts, including the first one in March. Now we are a little under 2 cuts for this year. First one maybe September, and the S&P is up 15%, largely because growth expectations have improved, earnings expectations have gone up. So if the Fed's waiting because growth is strong, that's not a bad thing for the markets. I think the path thereafter is kind of uncertain, but the timing I think is less relevant for the markets if the economy is doing fine.
The timing is less relevant for the markets, but what about the magnitude? We've been having this discussion really for the past week about a broadening out. What magnitude of cuts do you need for things like small caps, for the more cyclical parts of the market to actually become attractive again?
So it's interesting. I think the consensus view is clearly among investors that we're going to have a soft landing. But I think there's lower conviction that the soft landing is going to consist of solid growth, disinflation, and the Fed can do insurance cuts. To think about what happened last November when inflation came lower, you had some Fed officials out there talking about maybe we can proactively cut. That's when small caps, that's when cyclicals really rally for about 2 months. Now it's a little bit concerned, well, maybe the Fed's going to come to the party a little too late and cut their rates. So I think the market needs to be comfortable that this whole sort of really benign macro conditions can play out to really want to rotate away from the quality growth tech stocks that have done well and broaden out into look to these more cyclical parts of the market. That probably won't happen for a few months at this point in time.
Blurina, I want to bring that idea to you that Jason mentioned, this idea that is the Fed going to be late to the party? Because while for every dove like a Daly that talks about the fact that the labor market is turned, there is a Bowman who talks about the fact that inflation could rear its head, and that would mean potentially another hike. Is there a risk of a policy error at that point when you can still hear that type of language as there are other metrics that start to soften?
I think this kind of language and talking about possibilities and risk scenarios is actually quite helpful. It does prepare investors to better understand the Fed reaction function. I do think that the bar to say hiking interest rates again is pretty high. It comes with accelerating inflation, but that would only happen if the economy itself is resilient and growth is reaccelerating. We're having here persistent inflation in the US economy because demand is resilient. I don't think we're seeing the kind of cost push, wage inflation spiral. So I think this is important to understand. And then I hear a lot of talk about the unemployment rate and the recent increase. I would say that the unemployment rate is a very good summary statistic. It's very important. It's the Fed's target and so on. But this debate, I think, ignores the fact that there is some uncertainty about how reliable are household labor market data versus establishment data? Are we undercounting population growth and immigration growth in the US? And I think this will all feature into the Fed's reaction function and their decision making.
You know, I think from both of you, you're hearing a lot of strength. You're looking at a lot of strength in the economy. And Jason, to that point, why aren't we seeing that conviction in markets? Yes, we're seeing all-time highs, but we've been talking about all week. It's really on the heels of a couple of names or one name. It's not any kind of convicted sort of under-the-hood rally.
So I think if you look at market performance over the past, say, roughly 6 weeks, it's interesting because the tech sector is up for a lot. NASDAQ is up. As a result, S&P is up. But things like the small cap index, the Russell 1000 value, they're actually flatlining. And to me, that's a signal that the market's kind of skeptical about the growth story. And as valuations go higher, as the market kind of goes higher, there's an issue where, like, do you actually want to chase that performance? Because, again, maybe the growth is slow and we don't know. We've seen the data, especially for the past 8 weeks, economic data surprise to the downside. We don't know, is this asymptoting sort of like kind of a soft landing, or is it going the other way, kind of falling off a cliff? We just don't know yet. I think investors are a little bit cautious in believing like we're doing this when in fact we could be doing that.
Chris Harvey made a point that the reason why people are still, though, so bullish is that no one has been penalized. Earlier this year, people were talking about 6 cuts. That didn't happen, yet you do see the stock market continue to make new all-time highs. Is there something to be said for that? No one got hurt and continues to do well, just basically continuing on these consensus trades?
So I think I would kind of break it down to the macro fundamentals that we have an environment where growth should still be fine, like around 2%. Inflation still looks like it's going to come down, and you have a Fed that's biased towards cutting rates. If you give me that sort of recipe, this is the macro environment, that's generally supportive for risk assets. And that leaves out the whole AI story of like a kind of driving things higher. So if you have those conditions that you think still are generally directionally supportive, it's hard to get sort of, kind of too bearish in the markets at this time. Now, the fact that markets are up, I think people are probably been underweight risk to some extent relative to how well things have done. I think we talked about this a little earlier. It's hard to, it's just as hard to be underperform as, when the markets are going higher as when the markets are going lower and you have too much risk on. So I think that's forcing people to kind of stay, you just have to be invested. If you aren't, you're going to, at the end, you're going to be lagging your performance.
And if you try to gather some sort of narrative to drive the market on a macro level, you'll probably drive yourself crazy, as I think we all have. Lorena, to that point, you mentioned the craziness of the labor market data, that you can look at a household survey that shows weakness, you can look at NFPs that still shows some strength. It is confusing. I wonder what you make of what you hear from corporates. Are you hearing any more clarity when you hear someone like a Carnival say that people are still growing on cruises, or you hear pools saying that people don't want to build pools on their backyard, or Target yesterday saying that they're going to cut even more prices on their goods? Are you getting any clear picture at this moment from corporates and their exposure to the consumer?
So what I'm watching very closely is announcements of layoffs and how companies are discussing the tightness in the labor market. So what I see from the data is certainly a loosening in the labor market. Labor is not as hard to come by, and companies are not hiring at the fast pace that they did in 22 and part of 23. But at the same time, I'm not seeing widespread layoffs in all the survey data from the companies, but also the Challenger report and so on. So this suggests to me that we're not at the point where the labor market is about to sour, because if that happens, then we should start thinking, how sustainable is this recovery? So I'm getting a good signal from that. And then on the consumer spending story, it's going to be complicated and complex during this recovery. We are due for a correction in goods consumption, and that's finally materializing. Mind you, it's happening maybe a year or a year and a half later than consensus first expected it. But there is still some pent-up demand and resilience in services, and that's where Carnival and cruise ships and overall consumer discretionary services spending comes in. So again, it's not going to be a very clear picture, but understanding that this recovery is playing out in phases, and I think the services strength, that phase of services comeback, is not over yet.
So this really is an interesting point, given the fact that so much of good spending has actually derived typically from home building and home moving and everything that comes around the housing industry, which has essentially been frozen in place for quite a while. We've been talking about this consistently for the past couple of weeks, that it's very unclear, Jason, exactly what will happen when the Fed starts cutting rates. Does that lead to more volumes and more potential supply that leads to prices to go down? Or do you have all of this pent-up demand unleashed when mortgage rates go down just a little bit? Where do you stand on this?
It's a great question because ultimately it comes down to, look, in some way, how restrictive is monetary policy? Why have it not really kind of slowed the economy? And one would think if it hasn't really slowed the economy, then maybe cutting rates at the same time wouldn't be that stimulative. But I think there's an argument to be made that the housing market we've seen when mortgage rates came down last fall, suddenly housing starts, home sales kind of picked up, that there's kind of this pent-up demand. I'd also think even for a lot of small businesses that rely, say, on bank lending, they're borrowing at higher rates than if you can go into the public markets and issue debt at really low rates, that if those rates come down, a lot of sort of holding off on making new investment, that could ramp up. So I think in the Fed's back of their mind, or probably front of their mind, is if we cut rates, is it something where the economic activity can reaccelerate pretty quickly and then sort of financial conditions ease? We just don't know. I think it's kind of an open question. And the argument that it may not be that stimulative, I think there's a risk that it could really kind of ramp up activity enough that it just creates inflation concerns again.
Just to apply that to what you buy, does that mean that even if the Fed is cutting, the impetus for bond yields then to move down isn't as straightforward?
Well, if they're cutting and it ends up being stimulative, I think the risk is that the 10-year instead of kind of going lower, which is a typical pattern, the Fed cuts rates and you see the 10-year goes lower, that's kind of part of our thesis. The risk is that actually that's not the case, that they go lower almost reactively, and then it turns out economic activity doesn't slow, and then we're 6 months, 12 months down the line, and you realize we're still growing at 2.5%, and maybe the 10-year should be at 4.5%, not below 4%. I think there's definitely a risk of that happening.
Lorena, you have a lot of notes regarding the housing market right now, the inventory for the housing market. If we could just go back to that, what do you think will be the end game if the Fed if they cut, it's only going to be what, maybe 25 basis points, 50 basis points the entire year? Is that really enough for people to want to get in that have been waiting on the sidelines because they're so concerned about mortgage rates?
So here's how I think about it. First of all, I agree with the point that there is pent-up demand for housing. We started this hiking cycle with very tight inventory, and that has only gotten worse because builders are not starting new homes. We have the mortgage lock, so people are not bringing their existing homes into the market. So inventory has become even lower. I think the question here is, even what we know from the Fed is they want to cut and start a series of cuts. And I think what happens when they deliver the first cut is that the 10-year will respond. This is the risk. And will price even more cuts that maybe the Fed will eventually be able to deliver. And then this loosening in financial condition, and particularly in interest rates, could give the housing market that leg up and release that pent-up demand. It's not going to be about just one cut or two. It's going to be about what the 10-year price is and what the market price is for the Fed. That's the real risk here. And if that happens, we're expecting a deceleration in shelter, CPI, and PCE, and that's really fundamental to bringing inflation down to 2%. And then the next leg of that risk playing out is that the progress that we expect on shelter inflation is undermined.
Well, Renmac's Neil Dutta earlier this morning basically said, stop it with all of this, that basically if you look at the data and you stop cherry picking, as he told me in so many words, then you'll actually see that it's important to do an adjustment because inflation is coming down and growth is slowing. And so if the Fed doesn't cut now, they're going to risk having some sort of Fed error. Do you agree with that, Lorena?
I think it's very nuanced right now. It's more nuanced than that. I do feel like it's cherry picking season at Bloomberg Surveillance this morning. But it's important to understand that in this complex environment, the patient approach that the Fed is delivering is the right one. We do have a lot of firepower should the economy decelerate, but I also am of the opinion that that first cut and the decision to start easing is very consequential because of how the market will price it. Just remember, in January, we were pricing 6 to 7 cuts. And so I'm not pessimistic on the economy. If you think that the Fed will deliver 2, maybe 3 cuts, that means that other people's baseline view is not for a sharp recession. And then in this scenario, just having more confidence on the progress on inflation is right. Waiting before you deliver on that easing in monetary policy.
Jason, is it cherry picking here on surveillance or just globally, generally right now, because that's all that people are left with?
I think it's more like Rorschach test. Like if you have sort of preconceived notions and you look at the data and you sort of interpret it in the way you want. If you are optimistic, you can tell an optimistic story. If you're more pessimistic, you can tell that story. I think that's reality. Because I've had smart people on both sides say what Neil would say, that the Fed's going to be too late, and other people say that it's crazy for the Fed to even think about cutting. The economy's not slowing down. And this is kind of the reality we're dealing with. Still data that's noisy, distorted, kind of from the pandemic. I'm most focused on Friday when we get the PC data, not the inflation piece, but the consumption expenditures, because we see goods going lower. But at the end of May, we set record travel for kind of going to the airport. So are people still spending on services, and that's strong, versus goods? So the picture is really kind of fuzzy, and I think, again, you can sort of draw your own conclusions. And that's a challenge, I think, for the Fed, but also for us. But as long as it's not really deteriorating, it's sort of still, I think, kind of generally risk on.
We like cherries. Jason Draho of UBS, Blorina Orici of T. Rowe Price. Both of you, thank you so much for being with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief with our own Yahira Hackes. Yahira.
Hi, Lisa. We start with Disney, as the Fast Pass may be about to get even faster at Walt Disney World. Starting next month, Disney's Florida theme parks will let visitors reserve a space in line for rides up to a week in advance. Currently, parkgoers can only book a day ahead. The new system will be called Lightning Lane MultiPass. Guests at Disney hotels will be able to make 7-day reservations for up to 3 rides. But it's going to cost you. For example, the MultiPass, which allows 3 reservations, starts at $15. Micron is set to report earnings after the closing bell today, with investors looking to see if the chip maker's $62 billion AI-fueled rally has jumped too far, too fast. Investors are setting lofty expectations for the company, with revenue estimates coming in nearly 80% higher than the same period a year earlier. Micron shares are up 65% this year, with much of that advance coming since the company's last earnings report. And Airbus has a new warning for airlines, the plane maker saying deliveries due in the next 2 years are at risk of being delayed. Sources telling Bloomberg that Airbus has been notifying customers in recent weeks, and some deals are at risk of reaching contracted deadlines. The company cutting its outlook earlier this week as it struggles with shortages on parts, and it's also delaying plans to increase the output of the popular A320 jet. That's your Bloomberg Brief. Lisa?
Wonderful, as always. Thank you so much, Yahira. Up next, setting you up for the day ahead, this is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
about 37 minutes till the start of the opening bell. Counting down to that, here is the trading diary for the next few days. We get new home sales coming in around 10 a.m. Eastern, and at 1 p.m., can't wait for this, the U.S. is selling $70 billion in 5-year notes. Thursday, durable goods come out, plus another round of jobless claims. Of course, also the first presidential debate that comes out as 9 p.m. Eastern. Then we'll close out the week Friday with PCE deflator and personal income and spending ahead of University of Michigan sentiment. One theme this morning, are we cherry picking the data?
You have to have a fundamental framework for why the data will move the way they do. You can't just be a slave to the high frequency numbers as they come in. The only data that matters, Lisa, is unemployment and core inflation. Those are the indicators that are in the Fed's SEP.
So evidently it's cherry picking season on Bloomberg surveillance. And on one hand, yes, that is true. I mean, how do you sort of look at all of the bespoke stories? And if you try to extrapolate out a theme, probably you are going to be a victim of cherry picking, and you can be accused rightly of such. At the same time, how much is this a Rorschach test? Basically, where we're looking at a lot of, as Jason just said, a lot of different factors, and you can pick out what you want. I'm not sure the answer, because you hear smart arguments on both sides.
But I think just ultimately it comes down to there are risks on both sides, that it's hard to have conviction about anything because there does exist a Walmart that's concerned about growth, and Target and Pool and Carnival. These risks exist, and you can see why the Fed would want to be patient, because potentially they could be wrong. I think to say, look, there is a clear trend and nothing challenges that except silly high frequency data, I mean, you could be wrong because there is data that tells you you are wrong.
I loved Chris Harvey's point, though, is that the fact that no one has been penalized for what we've seen over the past 6 months, and basically investors just think they can walk on water. But when you're dealing with this kind of market, how can you not invest, say, or continue to go in all in on NVIDIA? Because that's what continues to drive the stock market.
One carry water, you bail out to the next, and then you can tell stories with Steve Eisman. Coming up tomorrow, economist Joseph Stiglitz will be joining us, TPW's Jay Pulaski, Henrietta Trey's of Veda Partners, and Evercore's Ed Hyman, who's been talking about the roaring 20s, and others are coming around to his view. More people actually talking about the idea that this indeed is more of a roaring 20s type of model rather than, say, some sort of 1970s model. And this, to me, is sort of the interesting question, especially given where the Fed is right now. Do we see a roaring 20s off the AI stories that overwhelms the underlying fundamental economic cycle that is already taking place in certain stocks? You're seeing that this morning with basically flat on the basic index, or at least on the NASDAQ, but S&P futures now down 0.2% as longer-term yields rise. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977, when by then I had a little research station, and 4 of my students were kidnapped, and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember so in some ways it is a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
From New York City for our viewers worldwide, I'm Matt Miller. Futures turned down after the second worst breadth we've had in a rally this century in yesterday's session. The countdown to the open starts right now. Coming up, futures running out of steam as Fed officials cool rate cut expectations. And the Japanese yen weakens to its lowest level since the 1980s, raising the risk of intervention. Plus, Volkswagen invests $5 billion in a joint venture with Rivian in order to gain some momentum on Tesla or any of its EV rivals. We begin with the big issue, the momentum in stocks continuing to stay very concentrated.
It has to get worse before it gets better. In other words, you need the economy to slow down. You need people to see the economy slowing down. You need the consumer to pause a little bit more, and then you have to pull Fed fund expectations forward. You need them to start cutting sooner and a lot more aggressively. And until you see that, there's no rotation.
Joining us now, Nadia Lovell is UBS Global Wealth Management Senior U.S. Equity Strategist. Nadia, great to get some time with you this morning. As I said at the top, yesterday was the second worst breadth we've seen in a rally so far this century. Only 113 stocks on the S&P participated in yesterday's rally. Is that worrying to you?
No, I mean, Matt, yes, as you noted, we've had a market that's up 15% year to date. And we would have thought that that would have been accompanied by a broadening out and improvement in breadth. I mean, we know that we saw that at the top of the year where you had about 40% of the S&P 500 constituents outperforming in the first quarter. That's narrowed to 25%. And yeah, we're going to continue to have this ongoing debate around market concentration. But when you think about it in it of itself, it's understandable and somewhat justifiable why some of these large mega cap companies are up so much this year, because it just comes down to earnings math. I mean, the fact is there's a bifurcation in earnings coming out of that first quarter earnings season. We did see many of these companies be able to beat and raise even high expectations. And the fact that you did see like CapEx intentions around AI increase. And so we continue to think that this is a story that will continue to play out, and any sort of pullbacks that we see will be more technical in nature because the fundamentals are there. And so we don't think that this is overly a concern in terms of the market concentration, because the earnings power is coming through on these companies and they're being rewarded for it.
You know, Nadia, a lot of this rally still seems based on optimism that the Fed's going to cut more than the dot plot shows is planned. Mickey Bowman, again yesterday, member of the Federal Reserve Board of Governors, repeated that inflation risks are to the upside and that it's not appropriate to cut right now. Is no one listening?
Well, we knew that there was dispersion among the Fed. We saw that in the updated dots. I mean, some at 0, some at 1 or 2 cuts for this year. And of course, we're hearing that in the rhetoric in the Fed speak this week, as you noted, Bowman pointing to no cuts this year and the potential for even a rate cut if inflation ticks up again. But then you have someone like a Daly, that's more on the dovish side, and even Cook, who was pointing out that we might be near an inflection point in the labor market. I mean, we'll see what PCE holds on Friday and then payrolls next week. We know that we'll get 3 CPI between now and September. We think that the data is going to show incremental progress on that disinflation path and be able to give the Fed the evidence it needs to be able to cut. So we think September will be a live meeting. Maybe we'll get some sort of indication of that at Jackson Hole in August. So we're looking for 1 cut in September, then followed by another one in December. But you know what? I don't know if the equity market cares all that much. I mean, look at how far we have come, despite the fact that we've had this massive repricing in the rate markets down from 6 to 7 cuts to 1 to 2 cuts. I mean, as long as earnings hold in there, we think that will be enough to be able to sustain this market.
I just saw that NVIDIA shares have turned negative in pre-market trading, and it looks like lately, as goes NVIDIA, so goes the rest of the market. Nadia, hang on 1 second, because I want to focus in on the economy. You talk about PCE and the payrolls data. We heard Neil Dutta earlier on Surveillance say those are the only data points that matter. But a lot of people are paying close attention to housing, and we got some of that out this morning as well. Bloomberg's Michael McKee is our chief economics and policy correspondent, and he's got the lowdown on housing this morning. What are we looking at?
We're looking at kind of low down, a little bit better, but it's not a good long-term trend. We have to be concerned about in the housing market. Mortgage applications down just a touch last week. Single-family applications down just a touch, but they were down 6.6% in the month of May. And today we get new home sales for May. They were down 4.7% in April. They're only expected to be down 0.2%, but new home sales still a problem for the economy. Home sales in general, if you take a look at what's been going on with GDP, we had seen for a while that the overall numbers start rising for home investment. New home sales, as you can see, down, except for mortgage applications for new homes have been up because builders are giving people incentives, buying down some mortgage rates, some as low as in the 5s, and that has helped keep new home sales a little bit higher than existing home sales. Now to the GDP aspect of it, home sales in general. They have been contributing to GDP for a while, and then over the last year, they've fallen off tremendously, and they're starting to be a drag on GDP. And so let's see what happens when we get the new home sales report coming up at the top of the hour. Now, the interesting thing, Matt, is that even though home sales in general have not been good, and new home sales have, as part of that, not been good, home builder stocks have been doing very well. And they're the home builders are way outpacing S&P. We focus a lot on the Magnificent Seven and the tech stocks, but
yes, we
surprisingly, home builders have outpaced returns for the S&P over the last 2 years.
I saw yesterday the market was driven by 2 chip makers, NVIDIA and Chipotle.
Oh, that was bad.
Michael McKee, thank you very much for that. Mike talking about the economic data. It is really a market that is run by NVIDIA. Right now, as I mentioned, we have seen the shares turn lower in the pre-market trading, and typically the direction of NVIDIA will tell us the direction of the S&P 500. Nadia Lovell of UBS Global Wealth Management is still with us. Nadia, what's your take on the AI revolution? It's not only the chip makers. Obviously, you need the data centers. Recently, we learned you need DRAM. Of course, we're expecting people to upgrade their iPhones and maybe PCs. How important is this to you as an investor?
Yeah, it's one of our focus at UBS in terms of seizing the AI opportunity. I mean, we're starting to see a bit of a bounce back earlier, and at least yesterday. I mean, today we'll see how it goes, but it's further evidence to us that dips will be bought in the space. I mean, there's a lot of cash on the sideline. There are some people who wonder if they missed out, and there are even some investors who are still underexposed to tech and AI. We see this in some of our client base, especially internationally. There's this home bias. So we've been advising our clients to really buy on the dip because we think that the AI theme is the theme of the decade. I mean, right now we're really focused on that enabling layer. So as you noted, the chips, the data centers, the power supplies that are really involved in the build out of AI, you know, we continue to believe that there's significant runway ahead for this because of the supply constraint and the strong demand that you are seeing. You know, we sort of without like even a single stock view, of course, we'll be watching Micron earnings after the close because that's like the next major AI data point, if you will. And so we'll be listening very close for any trends on high bandwidth memories. But even outside of that, I will say, Matt, you know, our thesis on semis, which is largely driven by AI, but you're also seeing some of these semiconductors covering from benefited from a stabilization and a recovery in cyclical trends around smartphone, PCs, and servers, and it's somewhat all interconnected. So we still are quite positive on tech here.
What do you like besides tech, Nadia? I mean, if you know, this one sector that's rallied so far so fast moves out of the leadership spot, what takes over?
We also like industrials. We're most preferred on industrials. And then again, industrials could benefit from that, you know, potential cyclical pickup. Of course, you know, we've seen ISM manufacturing, PMIs kind of, you know, flirting and oscillating around 50. New orders look like they could pick up. And so that could help in the back half of the year. But also, it goes back also to the some of the mega trends and AI story that industrials are benefited from. You know, they're sort of the nuts and bolts in terms of the build out of the data center as well. And there's also benefiting from, you know, nearshoring and onshoring. When we've even heard, you know, comments around that in terms of around FedEx earnings last night, as well as sort of the automation mega trends that's happening in the U.S. as well. And so we think that industrials are positioned to benefit not only from cyclical, but also the cyclical tailwinds.
Anything you like? I mean, anything that's been hit hard, Nadia, that you think has fallen far enough to get back in? I noticed yesterday it wasn't just real estate that was down, but also consumer discretionary was now negative for the year. Those two industry groups are the only two of the 11 on the S&P that have fallen.
You know, we are least preferred on those two sectors. And again, I want to make it clear that our call on consumer discretionary isn't so much a call on the consumer. We're still quite constructive on the consumer, but it's more of the makeup of the index. I mean, you'll have this index that skews more towards good. You'll also have the top two companies that account for nearly 50% of the index. When you talk about market concentration, this is one in terms of market cap, the most concentrated sector. And as you know, noted, you know, Mike McKee noted earlier about some softness that we're seeing in housing. That has implications for big ticket items. And so we think that will remain a headwind and evolve. So like EV sales has been bumpy globally. And so we think that there's more downside risk to estimates on the EV side. So still a little bit too early to jump back into consumer discretionary. If we can see some easing on the rate front, that might be the opportunity.
All right, Nadia, thanks so much for joining us. Great to get some time with you. Nadia Lovell there of UBS Global Wealth Management talking to us about the sectors that she's interested in and those that she doesn't want to buy just yet. Quick note on FX. The yen is making some moves. Right now we're seeing the drop turn around in the dollar yen. Right now 160 is the level, and that's about the level that we've been watching, but you can see a little bit of a change in direction there as the top ranking FX official Masato Kanda is speaking in London right now, and of course, in Paris right now, and of course, the thought is that if this currency, the Japanese yen, continues to weaken, that Japan will intervene on Friday. That's at least what market players are talking about as a possibility. Let's get a look at some of the individual stocks moving ahead of the opening bell. For that, we go to Abigail Doolittle. Abby?
Well, we do have futures lower, as you know, Matt, but first let's take a look at two stocks that are working, starting off with the shares of FedEx, really popping sharply higher right now, up more than 13%. This, of course, after the carrier put up a much better quarter than expected, beating estimates. Importantly, they also raised their profit view. This comes after cost-cutting efforts, and they announced a $2.5 billion buyback. Investors really liking it, sending the shares right now to what could be the best day in 2 years. Also climbing, in fact, soaring, Rivian. Shares are up more than 30% on the announcement of a $5 billion EV pact with VW, where they will be jointly developing battery-powered vehicles and software. I was surprised to note that the bearish short interest on this stock is not as high as I thought. It's 16%, which is high, but with this kind of gain, I thought it was a much bigger squeeze, but there is clearly a bit of a squeeze going on there. Southwest Airlines, one of the stocks declining on the day, down 4.8%. They pre-announced to the downside. They cut one revenue view to RASM to down 4% to down 4.5% from the previous view of up 1.5 to 3.5%. That's pretty serious view, and the management saying complexities in adapting its revenue management to current booking patterns in the dynamic environment. I guess a very fancy way of saying demand's not quite as strong. And then NVIDIA, you were mentioning that turn to the downside. Matt, this is really remarkable, as you know, or noteworthy, given the fact that not so long ago in the pre-market, it was up more than 2% after yesterday's nearly 7% gain after the 10% drop in 3 days. Now back down 0.6%. It's going to be very interesting to see how all the volatility for NVIDIA chips and AI plays out.
Yeah, absolutely interesting. And of course, yesterday was fascinating because only 113 stocks gained, and the market was up 0.4%. That's the worst breadth, Abigail, that we've seen in 24, 25 years.
It was really noteworthy. And from a sector standpoint, I believe at the end of the day, there were 2 or 3 sectors higher, the rest negative, speaking to that negative breadth that you're talking about. And what makes it really noteworthy or worth watching beyond the fact that it's just the worst breadth in such a long period of time is that we're having these mini sector rotations day by day. So on Monday, we had one into value. Yesterday, violently into growth. Today, it's going to be interesting to see how it plays out. Right now, it looks like it's perhaps more evenly dispersed, but with NVIDIA going back to the downside, maybe it will be value's day to shine.
All right, very interesting markets indeed. Great that we have you with us, Abigail Doolittle. And we're going to talk, by the way, with one of Abigail's sources a little bit later about the commercial real estate market. Very excited for that. Coming up, with the EV market in flux, 2 automakers enter a $5 billion joint venture.
It is a lifeline for Rivian, and I think really it's really important not to get too carried away. This is a huge sigh of relief, really, rather than a cause for celebration.
We're going to take a look at the deal between Volkswagen and Rivian next. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, created, when you're solving a problem that's real for you and therefore real for the consumer.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is a huge sigh of relief, really, rather than a cause for celebration. Yes, it's good news. We know that the EV market, long-term wise anyway, is certainly something that's meant to be, it's going to be very prosperous. But it's, is $5 billion enough, really, for them to meaningfully rival what Tesla is doing, and particularly some of the players over in China as well?
One stock that we're watching this morning is Rivian, the EV maker surging after announcing a $5 billion joint venture with Volkswagen. The deal allows VW to get access to the startup's tech and really its huge brand equity for a much-needed cash infusion. Joining us with more is Bloomberg Technology co-anchor Ed Ludlow. So Ed, talk to us first about why this automaking behemoth, right? Volkswagen has like 12 brands, all of which everyone has heard of, needs this joint venture with a company that only makes 57,000 electric vehicles a year.
Because for Volkswagen, their efforts in software have been going very badly. The first phone call that I took last night from somebody close to Rivian and Rivian's board was like, look, this is a great deal for Rivian, but it speaks to Rivian's competence in software. What I'm hearing is that Volkswagen just had major issues with Cariad, the unit that it's set up to basically develop a software suite for everything from OS through to autonomous driving capabilities to compete with Tesla. They just couldn't do it. Think about the types of people that work at Volkswagen. They just didn't have the talent. So Rivian was seen as like a really good quick fix because Rivian's good at software and they've got good talent there.
I was talking with Monica Ray, who covers Volkswagen for us out of Berlin, and she noted that VW has penciled in 108 billion euros in investment in EVs and digitalization. The previous CEO, Herbert Diess, was pouring tens of billions into Cariad, right? But it's lost billions already in its first years of existence. They just don't make much headway with a ton of cash.
Yeah, and so therefore, like $5 billion up to $5 billion, because like the devil's in the detail of the structure of this deal, kind of seems like a drop in the ocean. I would focus on that because on paper, Volkswagen has the potential to take quite a controlling interest in Rivian. And so Rivian's quite clearly had to cede something here, give something up. But initially, it's an equity stake through an unsecured convertible dated December 1st, with the promise to buy $1 billion of equity each year, 2025, 2026. But if the stock goes up for Rivian, think about the dilutory effect. VW might not end up with that big a percentage of the company, but it's a good hedge. They're forming this joint venture where, Volkswagen gets access to Rivian. So if Rivian is as good at EV technology as the market believes, VW gets that. Rivian gets the brand recognition, I suppose, that you just flagged. One note of caution, though, I would say look at the final paragraph of the story and how many joint ventures Rivian's pulled out of over the last 5 years.
Obviously, Amazon owns a huge stake in Rivian. Ford had a huge stake in Rivian. They canceled a deal with Mercedes-Benz. But I really think the Rivian brand is going to be helpful to Volkswagen because people love these vehicles, right? They're expensive, yes. Rivian loses like 40 grand on each sale, but we're talking about 1,000 horsepower in the quad motor Rivian, right? Massive amounts of torque. It's a real status symbol, and they're supply constrained, aren't they? I mean, they could sell as many as they could make.
Yeah, and really the story with Rivian is trying to work out the manufacturing side of what they're doing. A lot of emphasis on this story is the next generation Rivian, R2, R3, which is kind of their attempt to compete with Tesla's Model Y. They had shifted the launch of that vehicle to their existing plant in Illinois, but they remain contractually committed to building a new plant in Georgia by 2030 and investing $5 billion. So the cash injection from VW helps. The question is, what does this JV between the two actually do? A lot of folks were speculating about the Scout. I don't know how interested you are in the Scout project.
I have been speculating about it myself this morning. I mean, they could just rebody an R1S to make it a Scout.
But then look at the Scout's profile and look at the R2, R3, and I use this term not lightly, but frenemies. Rivian's had to give something up here, and I'm still trying to work out what it is beyond the kind of positive headline, and I get the stock's up a lot, that Rivian's getting access to, because what Rivian needs is capital,
right,
and it's up to $5 billion, not a certain $5 billion, but they also need some manufacturing help as well.
I mean, that's the hope, right? That's why we see this 36% pop in the stock pre-market. Rivian gets the money to build the Georgia plant. Maybe they can go from 400-volt architecture to 800-volt. Maybe someday they can actually put Apple CarPlay in a $100,000 vehicle. That boggles the mind that they don't have that. The problem is, you know, Volkswagen made a partnership with XPeng. The stock soared in China and now has lost 2/3 of its value.
Yeah, and again, I look at Rivian's track record with JVs. I think the point is that for the legacy OEMs, they're still hedging their bets. You look at Ferrari now talking about doing a hybrid, for example. There's a recognition that this is one strategy. You acknowledge the competence of the pure play EV makers. Rivian does have a great product, good talent. It just needs help executing on it, and execution's kind of key. They've de-risked the balance sheet with Rivian with this partnership. And at the same time, VW can hedge its bets, continuing with many gas or combustion engine models, and continue to look at hybrids, as many of the legacy OEMs are, with the offset of the partnership with an EV maker that's focused on one thing and one drivetrain.
Right, Ferrari's SF90 Stradale already a plug-in hybrid. I think you should take a spin in that, Ed, when you get a chance. Bloomberg Technology co-host Ed Ludlow, definitely want to tune in for their program at 11 a.m. for more on this, I think, massive story, and Ed is our EV expert. I also think you should pick up the new issue of Bloomberg Business Week. You get an exclusive interview with LVMH chief Bernard Arnault, often the richest man in the world when he moves up and Musk moves down. But it's a whole new format for the magazine as we relaunch Business Week. Coming up, morning calls, and then later Jay Hatfield joins us. He has an S&P target of 6,000. This is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Could face bigger challenges next.
Was going to keep winning World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome to Bloomberg The Open. I'm Matt Miller. Just ahead of the stock market open, we get a whirlwind of activity in FX and rates. Here's the Bloomberg U.S. Bond Index hitting its highest level so far this year after, well, really some divergence shows its face. The Fed seems far away from cuts, the ECB seems much closer, and the yen falls against the greenback.
just looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Aman Hotel Group, where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
This is the countdown to the open. I'm Matt Miller, moments away from the start of trading, and we have a lot of activity in currencies and in bonds right now. The yen hitting a fresh 38-year low against the dollar after candid comments out of Paris. The dollar hitting a fresh high for 2024. The euro falling against the dollar as well, and a sell-off in treasuries pushes the yield up. Nonetheless, let's focus in on stocks, at least for a moment, as you hear the opening bell on the NASDAQ and the New York Stock Exchange. We're down on S&P futures, and you'll see us drop in the cash trade as well. That's because NVIDIA has turned lower. NASDAQ also going to be down, as well as the small caps. But let's pan over to the other board right now. I usually dance right past this. Look at the euro, down with a 106 handle right now. Some real divergence forming, as it looks like the ECB is going to cut again, even with all the election volatility over there. The Fed, Michelle Bowman, saying it's going to be difficult to do that because the risks to inflation are to the upside. Right now, you can see a sell-off in treasuries pushing the yield up to 4.30. We were at 4.25 this time yesterday. And NYMEX crude just hovering around $80 a barrel. We don't have the yen there, but we should probably pull it up right now. Their top currency, Japan's top currency official, talking in Paris, saying you've seen drops too far, too fast. That may indicate that we're headed for some intervention. That's what a lot of talk in the markets is about, expectations possibly for Friday, but could it come sooner? I guess, as we go over 160 yen for the US dollar, headed now towards 170. You can see right now we're trading there at 160.58. In terms of stocks, one that we want to watch at the open, one stock that isn't NVIDIA that we want to watch at the open is FedEx. It's up after forecasting profit better than Wall Street's expectations. For more, we're joined by Gail Doolittle. Abby, what do we see?
Yeah, it's up in a big way, Matt, up more than 10%, heading to its best day in 2 years. And this comes on a number of factors, including that raise of the profit outlook that you were mentioning. They've been cutting costs. They're saying that they will achieve $2.2 billion worth of cost cuts by the end of this year. They also did beat estimates for the quarter. That was a modest beat, but nonetheless, it does signal a slowdown in the decline for their parcel business. So that is really pretty important. The CEO also talked about the process of consolidating the Express, the ground, and the service units. This could be a really big shift for their business. Apparently, Express has been having a bit of a stall given the inflationary environment, folks opting for the ground. Also, they hinted at the possible divestiture of their freight business, JP Morgan in particular, some analysts surprised by this. But overall, Matt, what really amazes me about this stock is it's been stuck in a range between about $224 and $290. It is basically at the top of that range right now. So investors are are either going to need enough good information to push it up and out of the range, or we could actually see FedEx go right back down in that range. More information is needed, but right now investors encouraged by these recent results.
All right, Abigail, thanks very much. Abigail Doolittle talking about FedEx. Meanwhile, General Mills is dropping at the open, and it's the biggest drop for the cereal king since May of 22 as shoppers pull back on spending. For more, we're joined by Bloomberg's Simone Foxman. I would think, you know, when money is tight, cereal's the only thing I eat.
Yeah, but frankly, General Mills has been passing on a lot of its net sales increases in pricing. And finally, what we are seeing is this slowdown in actual volume coming home to roost. We're seeing declines over 5% in those stocks today. That's pushing this stock into negative territory on a year-to-date basis. And when we look at some of these results in the fourth quarter, we saw organic net sales decline 6%. That's roughly double what analysts on the street were anticipating. A lot of this weakness coming from North America, from the pet segment. Canada actually a standout here with sales increasing mid-single digits. For the fiscal year just ended, we were watching organic net sales down 1% year on year. And one of the troubling things for analysts as well is the guidance, expecting organic net sales to rise 0 or to be flat to up 1%. That is less than the street anticipated. Jefferies says this is just evidence that that value-seeking behavior is persisting. And again, you know, we look at food at home inflation up just 1%. There's no price increases through. We really got to focus. Investment market doesn't love it though.
Right now, we're trading lower in the pre-market. Oh, no, now the cash trade is lower. Little bit of volatility there, and the S&P is down again. I just wanted to point that out as we talk about Micron. It's been gaining ahead of its earnings report after the bell today, and of course, Micron could be a beneficiary of the NVIDIA AI craze. Natalia Knežević joins us now to talk about Micron. And Natalia, what do we expect?
So Wall Street is expecting Micron to post about $6.7 billion of revenue in the past quarter, and that would be above company's guidance for both earnings and revenue. And this would be an 80% jump from a year ago. So these strong results could primarily be driven by pricing power. We know that Micron has been raising prices over the past 6 to 9 months, and analysts expect this to continue throughout 2024. So we know that supply chain remains constrained. Demand is improving for PCs, servers, smartphones, which is good for a company like Micron. And we know that revenue has been increasing, gross margin has been increasing, and analysts expect that Micron can post its first positive free cash flow. So we know that there are some concerns about production capacity around DRAM. This is a memory chip that is produced, about 60% of its capacity is located in Taiwan. There was an earthquake and it disrupted production. They're saying that increases can potentially offset any production impacts for DRAM. Analysts will be watching for any commentary around CapEx for 2024 and 2025. Of course, any comments around demand for AI-related products as well, and any updates on DRAM production. The stock overall is up 65% year to date. Analysts are really positive. The stock has got a few updates ahead of earnings. We have 37 buy ratings, 2 hold, and only 1 sell rating for this stock.
All right, Natalia, thanks. Natalia Knežević there talking about Micron and DRAM. And by the way, Ed Ludlow points out to me it's not just about DRAM, but also HBM, which is high bandwidth memory, a kind of chip I didn't even know about. So thanks to Ed. Tune into Tech at 11 for that. Joining us now is Jay Hatfield, founder and CEO of Infrastructure Capital Management. And Jay, you know, it's interesting to see the volatility in NVIDIA today, but yesterday we saw NVIDIA as one of the sole drivers. I mean, only 113 stocks were up on the S&P 500, and the index was up 0.4%. How important is this stock?
Well, it's really critical. It's the reason the market's up this year so far. But it's the reason that we are bullish on the stock market is it's broadening beyond NVIDIA. And most importantly,
but yesterday's breadth doesn't show that, right? I mean, it was the second worst breadth this century.
Well, this is a bull market pullback. So June's usually a terrible month for stocks, but that's how bullish this market really is this is a pullback where you get rotation. So every other day it's tech's up. Today, actually, most things are down, but tech's up, value income stocks are down. That's what we invest in, so we're very focused on that. But other days, oh, NVIDIA's down. Well, guess what? All of our stocks are up. So that's what happens in a bull market during June, which usually the market would be way down. It's just up at all-time highs. So pretty normal behavior. We're bullish, though, when we get into earnings, we'll get a broader based rally.
So when you say all of our stocks, what are you talking about? What do you see as value? What do you like right now?
So we like large cap dividend stocks, small cap dividend stocks, preferred stocks, anything with yield, which is not in favor. Rates have traded off 45 basis points this year. So those are out of favor, super cheap, trading below 15 multiples, no hype whatsoever. And so we think that rotation will start, and we'll have a power rally in the summer where we'll have both major sectors going up.
Do you need rate cuts for your story to play out the way you want it to?
Rate cuts are lower 10-year. I mean, if the 10-year just magically went down, which almost never does, but we think that we're going to get weak data. The labor report will be indicative. It's very volatile, so it could be misleading. But we've seen claims weaken. So we think that there'll be an anticipation of a September cut. And in July, they probably won't cut, but they'll be more dovish and lay the groundwork for cutting, which should power a rally during the summer.
So payrolls, Neil Dutta this morning was saying only two data points matter, payrolls and inflation. I guess PCE, right? Because that's what the Fed says is their preferred measure.
Yes.
We're going to get that. How do you see inflation trending? Continuing the downward trend? Did we just see a pop that was out of place in the beginning of this year?
We absolutely believe that. Oil is a great short-term indicator. It was way up in the first quarter. It's way down in the second quarter. So, and PCE is going to be 2.6, so that's low enough for the Fed to cut. All they need now is the labor market to clearly soften, and even Mary Daly mentioned that a couple days ago. So there's early signs that the Fed will figure this out and at least indicate in July that they're going to cut in September.
One of the things I thought was interesting from Bowman's speech a couple of days ago when she first said, you know, the risk to inflation is higher, no need to cut right now. I know she's only one, you know, member of the Federal Reserve Board of Governors, but she said that the amazing amount of immigration that we've been getting, the floods across the border, have really boosted the supply of labor, and that the new restrictive approach that the Biden administration is trying to take, the restrictive approach that you know President Trump is going to take, or if he's elected, will kind of goose the labor market a little bit. How important do you think the November election is?
We think that the election will be fine for the stock market. The most likely case when you look at all the probabilities is we have divided government. House may go to the Democrats, Senate to the Republicans. That's the way the math looks. And I really don't know on the presidential. Turnout is critical because nobody's going to change their mind. So if we have divided government, we'll have lower government spending, more stability. We'll have the opposite of Europe where you have a parliamentary system and there's a huge change in policy. So we should have gridlock, which is good for stocks because rarely do federal government policies help corporations.
Lower spending, you mentioned. There's been a lot of talk about deficits recently. Bill Dudley is out with a column on the Bloomberg saying there is a reason to worry about it. Steve Weissman was on surveillance yesterday saying he doesn't care. I've talked to Ed Hyman who says the bond market doesn't care and the dollar doesn't care and we just hit a fresh high for 2024. I don't care. Do you care?
Well, we care. Our estimate is that running these irresponsible deficits chops about 1% off of potential U.S. growth because savings equal investment, so higher government spending crowds out investment. But in terms of growing at a normal 3%, we don't think it's going to affect it. And the most important thing is not fiscal policy, but monetary policy, global monetary policy. If we get these rate cuts, we're estimating $2 trillion of injection in capital. And so that's way more important than our normal kind of 5-ish% budget deficit, which we've been running for 20 years since Clinton was president. So that's just normal, standard incompetence at the federal government.
Jay, thanks so much for coming on. Really appreciate your candid take there. Jay Hatfield of Infrastructure Capital Management. They recently raised their S&P target to 6,000, joining ISI, Julian Emanuel, on that bullish note. Coming up, betting big on commercial real estate.
So the good news for commercial real estate is, and it's very good news, is valuations have stabilized. It's a big market, and there's lots of really attractive deals to do. That's the good news. The bad news is that there's about $1 trillion of this debt that's upside down, where there's no equity value left.
Yeah. That's not bad news if you're buying. We'll speak with Namdar Realty Group CEO Yigal Namdar next on the firm's most recent big purchase. This is Bloomberg.
The names that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg.
So the good news for commercial real estate is, and it's very good news, is valuations have stabilized. It's a big market, and there's lots of really attractive deals to do. That's the good news. The bad news is that there's about $1 trillion of this debt that's upside down, where there's no equity value left, and the creditors have to work through this process of workouts.
That was Marathon Asset Management Chairman and CEO Bruce Richards. Another New York City office building was sold at a steep discount amid the deepening commercial real estate crisis. Empire Capital and Namdar Realty Group agreed to buy an office building owned by Related Fund Management for less than $50 million. That's roughly a 67% discount. Quite a deal. Joining us now is the man who made it, Namdar Realty CEO Yigal Namdar, along with Bloomberg's Abigail Doolittle. And Abigail and I, Yigal, have been fascinated. Bruce's comments that valuations have stabilized. That seems fairly optimistic after you do a deal like that. What are you seeing?
I mean, I agree that this should be the bottom of the market. It should be towards the bottom at least. You know, we're right in that level, and I think that the big issue is going to be all this debt. I said that I believe that most of the CMBS that was placed pre-COVID on assets that are not top tier, I would say A+ buildings, anything outside of that, majority of that is on the water, you know, and lenders are working whether they want to take it back, whether they want to make a deal with the sponsor, and just there's a lot of problems right now in the office space.
So in this kind of environment where you can buy an office building at a 67% discount from a major player, I mean, a related affiliate, that's pretty incredible. It speaks certainly to your negotiating skills. But what is the process? Are they coming to you as a buyer of last resort, or are you scouting out buildings that are of interest to you where you know the debt is underwater, that there's some kind of problem?
So right now, the best way to purchase these assets is through arm's length transaction with brokers marketing it. This was a short sale, so the banks want to go through the process of vetting out all the buyers and see who's the best buyer, who's willing to pay the most, and the surety of close. And we've built a great reputation over the years of...
Surety of close is key, right?
Yes, yes. And us being able to do our due diligence up front and sign hard deposits and close immediately gives us an edge in this market, because we've been waiting for 20 years for this moment, when others were, you know, we were fearful when others were greedy, and now we're greedy as others are fearful. That's a very smart man said that. And now it's our time to go out there. We're very liquid, and we want to be able to take advantage of this situation, correct?
Yeah, so that discipline is really paying off now. Talk to us about that liquidity. Is that really just from having built dry powder? And also talk to us about the connection with NAMDAR. Does that help you with financing?
Yes, so we've been doing our thing. When New York City prices were very high, we wouldn't be buying stuff. We would be buying our retail throughout 38 or 39 states. And we're well diversified in that area. We still have, that's our core business.
Your retail space, the mall business.
Malls and shopping centers. But now we've seen the prices of these office buildings have dropped so much that it's hard to not make money at these levels. And others have their challenges with the debt. They really are not in the position to be buying new deals because they're dealing with their problems, with the current lenders, with not being able to do build outs. And I think there's two advantages for our position. One is that we're able to buy these at a steep discount, which helps with making money. Secondly is we can afford, we have the liquidity to do the build outs, to do the tenant improvement work, to do the base building work, to modernize the lobbies, modernize the elevators, all this stuff that needs to get done in order to sign up tenants. Not only we can help to keep our tenants by being able to pay and invest in the tenant improvement work, and also being able to buy new tenants from other buildings that are
How much is it costing you to refit? Because I know that's a big chunk of change, right? I'm looking at deals that you're doing for $100 million, $150 million, $170 million, but you still have to add, I'm guessing, $10 or $20 million to refit these offices so you can get new tenants in there.
Yeah.
How much are you looking at on average in terms of refitting?
So, you know, it's a very capital intense business. And I think for that reason, our strategy is you have to buy the better buildings. You have to buy outside of New York, we're focused on A assets, the top 3 or top 5 buildings in that marketplace, because the tenant improvement work doesn't change whether you're in a C building or an A building. You still, the sheetrock and it still costs around the same. So the payback is way better if you own the better assets, and it is intense, and that's why we have to buy these assets at a steep discount.
So I have to ask the question I think everybody wants to know. You're talking about the steep discount. Bruce Richards talking about the idea that we're at the bottom. What are we talking? On 3rd Avenue, can you buy a building 25 cents on the dollar of what it was for B and C, or what kind of discount is it? Where are values?
I would say it's relative. An occupied building on 3rd Avenue pre-COVID versus a vacant building today on 3rd Avenue could be more than a 75% discount.
More than 75 cents. So are we talking 15 cents? I mean, that's incredible.
There are assets that are vacant that may sell in a double-digit price range.
Wow.
Under $100 or right around that range.
Wow, it's still a lot of money, though, that you're spending, right? I mean, where are you getting the financing? Are you working with banks? Are you selling bonds? What markets? How's it look?
So in our situation, we've always believed in low debt. So we don't have a lot of debt on our balance sheet. We have a good cash flow. And banks would finance us because they know we don't over-leverage it. And we're willing, in some cases, to give personal guarantee on some loans, while others want to do a non-recourse loan, which is almost impossible in office space today. We also have an Israeli company. We're public in Israel as well, so that also helps with them build up our trust over the last, I would say, 7-8 years. And, so we're able to have access to Israel money as well.
Yigal, thank you so much for coming in. It's so great to get your take on this market because it gives us an insider's view that otherwise we wouldn't normally have access to. And Abigail, great reporting on commercial real estate as well. Abigail Doolittle and Yigal Namdar from Namdar Realty. Coming up, the market moving events that you need to be watching this hour. There's a lot going on. That's next in our trading diary. This is Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
For the trading diary, what you need to be watching today and next week. We're going to get new home sales at the top of the hour, then a treasury auction on $70 billion of 5-year notes this afternoon. Very interesting to see as we get the sell-off in 10 years today, pushing yields higher. Micron, as we've been telling you, reports after the bell. Very big deal in AI, so we'll see what they have to say. Tomorrow brings the first debate between President Joe Biden and former President Donald Trump. We're going to round out this week with the all-important inflation number, the Fed's preferred gauge of inflation. The PCE comes out on Friday, and then, of course, next week, we're going to get the non-farm payrolls number, the granddaddy of all economic statistics. This has been the Countdown to the Open. I'm Matt Miller. This is Bloomberg.
look at the number of women that want to learn the game, young girls that are joining on the tee, really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our carpets here and all that sort of thing, but what else do we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines.
M&A that we've seen.
These are big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Invest Conference down here at 225 Liberty Street. That's what we used to call the World Financial Center back in the day. Great conference. We got a lot of smart folks down here, market leaders, and we'll be speaking with many of them over the next couple of hours as well. Norma Lynn is going to give us what's happening in the markets. We're going to check in with Thomas Black. He's a Bloomberg opinion columnist. He covers all the logistics companies. He can give us the latest on the FedEx results, which came in a lot better than expected. The stock moving sharply higher. Clark Cheng, CEO and Chief Investment Officer at Merrimack Corporation, is going to join us here and talk about these markets and managing people in these markets. So we got a lot coming up in this hour. But first, let's go to John Tucker and get a Bloomberg Business Flash. John, what do you have?
All right, Paul and Alex, we're being brought to you by Interactive Brokers. Interactive Brokers charging U.S. dollar margin loan rates from 5.83% to 6.83%. Rates subject to change. Learn more at ibkr.com/compare. Major stock averages, they are mixed right now. The S&P 500, 6 points lower, and that is down to 0.1%. We are at 54.62 on the index. The Dow Jones Industrial Average, 143 points lower. That is down 0.4%. And right now, the NASDAQ 100, that's higher, up 17 points, up about 0.1%. NVIDIA shares, after Tuesday's 7% gain, those shares right now, they are up 0.6%. FedEx, bellwether for economic growth, that surged after an upbeat profit forecast. Amanda Agati at PNC says, you know what, the bull case for stocks, that remains intact. In what may be a measure of market health, yesterday's tech rally, that was marked by the second worst breath this century. Only 113 companies were up The two biggest drivers were NVIDIA off its slump and Chipotle Mexican Grill. And some breaking news on the economic front. May new home sales rose at an annual rate of 619,000. That is lower than the estimate of 633,000 on an annual basis. And also some breaking news, Paul and Alex, from the Supreme Court. The Supreme Court backing the White House on social media posting. And joining me now in studio, Bloomberg host June Grasso. She will be along in a few minutes to give us some details on that. And let's return right now to the Bloomberg Invest Conference underway in downtown Manhattan with Paul and Alex.
All right, thanks so much, John Tucker. Yes, the U.S. Supreme Court clearing the Biden administration to communicate freely with social media companies in an election year, ruling that bolsters the government's ability to seek removal of what officials see as misinformation. That really centered around the misinformation around COVID-19, and it looks like the Biden administration can communicate freely with social media companies when it comes to disinformation. And we're going to get much more on that in just a moment. Let's get to the markets that are moving. There's some fun earnings that are out. There's the Rivian Volkswagen thing. Nor Melinda is joining us in the studio. Hey, Nor, what are you looking at?
Well, as you mentioned, I'm watching Rivian. So this stock is surging. It's really on a roll, up as much as 37%. It's teeing up for its best day since 2021. Now, this is coming after a massive cash infusion that's come from Volkswagen here, Alex. And this is through a $5 billion joint venture. And of course, we do know that the EV market has really seen a bit of a slowdown, especially with Rivian struggling with not only production, but also deliveries. And analysts are still seeing downside risk as we look at the EV sector. But Volkswagen will actually be starting with a $1 billion investment, and then it'll have $4 billion invested over time. And the perk for Volkswagen here, it'll get access to Rivian's technology for its own EVs. And of course, we do know that Rivian is good at software, Alex.
Yeah, and there's a great Chris Bryant opinion column on Bloomberg right now. I love the headline. Rivian is embraced by a needy German sugar daddy. Basically saying, that's kind of what it looks like. It's like Volkswagen saying, listen, we don't necessarily have the technology yet that we need, so let's go to somebody who may, really focusing on this business. And then if you're Rivian, you're like, thank goodness we've got their cash.
That's actually an amazing headline, and I feel like that actually worked really well. And I think that Volkswagen, if I'm not mistaken, actually hired some former Rivian employees also to help improve their software. But, clearly this is the next step forward. Nor, what else are you looking at?
I mean, I'm watching the airline space. Now, this is after Southwest Airlines cut its second quarter guidance for unit revenue. Now, this is because it says it's having a hard time adapting its revenue management to the current booking environment patterns. And so it expects revenue per available seat mile to fall as much as 4.5% this quarter. Now, it had previously said that it expected about 3.5% of a decline, no more than 3.5% of a decline. So this 4.5% expectation, of course, is throwing off investors quite a bit. We're seeing shares of Southwest tumbling as much as 4% in trading today.
It's interesting. I would have thought that airline traffic is still very good, but maybe there's a little bit of a pullback here that should be expected after all that, I guess, revenge travel that we had.
Well, it's also a difference between, I think, domestic and then international, and obviously Southwest doesn't have exposure to international, but also they have some technical problems too. They had that outage a couple years ago during the holidays that messed up everything, so they're just trying to sort of figure that out as well, so they have some idiosyncratic stuff going on there too, Nor.
Definitely.
What else you got, Nor?
I'm watching FedEx, can't stop watching it. It's seeing its best day in more than 2 years. This is after a strong profit forecast, and it actually said that it expects to buy back $2.5 billion of its stock over the next year. So, of course, lots of news coming out of this earnings, especially as we think about FedEx. It's really been trying to reorganize its setup and think of some cost-cutting measures, and it does appear to be paying off. It said that adjusted earnings in 2025 will be $20 to $22 per share. Now, this is above the midpoint expectations from analysts for $20.85. And another thing to note, of course, we've been watching the CEO. He's trying to merge Express, Ground, and Services units, which we do know is a shift from the two-network system that we've seen over the past few decades. As I'm watching FedEx, it looks like shares are up as much as 14% in trading this morning, Paul.
Yeah, 52-week high today. The stock's got a market cap of $71 billion, so it's had a nice move here. And, I guess for those guys, they're putting through a ton of volume through their system. Now it's just a question of doing it the most efficient way possible. That's
Right.
kind of where it seems like this company's focused.
I just also wonder too, like, what are you left with? If logistics business kind of goes away, then are you left with, that doesn't seem like a very, considering that a logistic business has lent so much to revenue, then what are you left with, and how do you sort of value that? Hey, Nor, we're at Bloomberg Invest. You were also at Bloomberg Invest yesterday. You had a panel called The Impact of Technology on Business Models. That sounds pretty fun. Tell me about it. What did you learn? Who was on it?
Yeah, interesting conversation as we were hearing from different people in management, ranging from industrials. We had representation from Honeywell, Verizon, as well as MetLife. And there were some really interesting things that came from that conversation, especially as we think about technology as it's getting adapted into different business models. And one thing that really stuck out to me was the representation from Honeywell. They essentially said that the industrial space is having a bit of a more difficult time adapting AI into their processes, especially as we think about industrials being more of a predictive space rather than speculative. And so things need to be right. And of course, they do have technology already in the industrial space, but they're saying they're seeing about less than 20% of industrial companies adopting AI as of right now.
Interesting.
Yeah. It's going to be, it feels like some variation of AI is going to be impacting almost every industry out there. It's a question of to what degree and in what form it feels like.
Yeah, and then how quickly all of that comes to be. All right, Nora, thanks a lot. Really appreciate it. Nora Melinda joining us from Bloomberg News. Let's get back to FedEx. Thomas Black is Bloomberg opinion columnist covering logistics, manufacturing, and aerospace joining us now. So what did you make of that news? In particular, a strategic spinoff maybe, or strategic options, I should say, for its freight unit. That pretty much surprised a lot of analysts. What did you make of that?
It was surprising. It potentially could unlock a lot of value, and I think that's why the stock price is up, around 15% today. Investors see that as kind of a little gold nugget that's been hidden in FedEx. It's the largest less than truckload carrier, and those trucking companies tend to have pretty high valuations right now, so they could definitely unlock some value.
So is the expectation that they will spin that out or IPO it? What mechanism are they discussing, do you think?
They didn't want to talk about it. They were asked several questions about that on the conference call, and they batted them all away. They're going to review it. Spin out would be easier to do, probably more tax friendly as well. They could sell it. I'm sure there would be some interested buyers in there. It's a pretty high margin business for the trucking company, for trucking industry. IPO, I presume they could do that as well. A spin would probably be the better way to get it, trading.
Yep. Just looking at this thing, just the most recent results, they're talking about their forecast revenue will grow in the low to mid single digit percentage in the upcoming period. But boy, they're talking about a big gain in EPS, net profitability. What are they doing on the cost side that's kind of bringing a lot more dollars down?
Yeah, the FedEx story is all about cost cutting. The parcel market is a little soft right now. It's been that way for a few quarters as people, the revenge traveling and all the revenge experiences that people are buying, they're not buying as much stuff. So the e-commerce and the package delivery market's a little flat, so FedEx is cutting costs hard. The new CEO, Raj Subramaniam, came in a couple of years ago and announced this big transformation of FedEx, and he's doing it. There was some skepticism about how this would work, but he's winning over investors now because they've had several quarters in which they have increased margins, even though their revenue has been on the decline because of the market pressure. So far, so good for Mr. Subramaniam.
So you had a great opinion piece out about FedEx, and you sort of broke down this logistics business and then what would be left afterwards, and how FedEx would be then a pure play small package delivery company, and then you'd have this behemoth logistics company, and just how much market share they really own. Can you talk us through some of those numbers? Because I think of what's left of FedEx will be quite interesting and how to value it.
Right. So what they would spin out would be their less than truckload trucking company, and these are companies that have a network of warehouses, and they bring in customers' goods and they consolidate them so that they can fill a full trailer instead of just taking a partial trailer. So they're essentially it's a trucking company So FedEx is going to keep all of its, if it did spin that, it would keep all of its package delivery business. It also has some logistics business in which it helps customers move freight around the world. They do custom stuff and forwarding and so forth. So they would keep that as well with the main company. So this would be a trucking company. They've tried in the past to help to merge these companies a little bit more. In other words, have the trucking company do some of the package delivery and so forth, especially some of the large packages.
Right.
But I'm not sure it worked out that well. So maybe that's why they're pivoting and saying, well, maybe we could unlock more value. Instead of trying to integrate it more into our system, let's just go ahead and carve it out.
You know, when we talk cost cuts in this business, a lot of times it means headcount. What have they done on the headcount front? Because it just seems like a labor-intensive business.
They definitely have lowered some headcount. I don't have the numbers off the top of my head, but that's one of the things. The other is they're trying to consolidate their networks. And if they're in the past, if there was an express facility and a ground facility in the same vicinity, they would just continue to operate those, and the trucks sometimes would arrive at your house. One would be an express truck, one would be a ground truck. They're trying to eliminate a lot of that duplication. So in some cases, they're consolidating facilities. They're handing off packages so that only one driver comes to your door or your business. So that's another way in which they're cutting costs. Mm-hmm. It's not all just headcount. It's
Before we let you
operational.
Yeah. And clearly also, you know, spinning out the logistic business will help some cash flow there. Yep. Real quick before you let you go, if the spin-off of logistic business went the way of M&A, who might be potential buyers?
Ooh, good question.
That's a little bit of shaky ground, but there's some large LTL players out there. I'd have to say XPO would determine that Brad Jacobs has made a living by acquiring companies. So I wouldn't put them. Where you're when corrupt, XPO bought the most of the assets and sold, and XPO came out with the lion's share of those. So it's willing to expand through acquisition. So I would put them on the list.
All right, very good. Thomas Black, thank you very much for joining us. Really appreciate it. Thomas Black, Bloomberg opinion columnist, just giving us the latest on FedEx. Better than expected results, taking guidance up. Stock moving up higher by about 13, 14%, 52-week high. How about that for our friends at FedEx? Let's get back to John Tucker in our New York studio. John, Supreme Court, we got some rulings today. The notable one, the crossing the tape, the Supreme Court backs White House on social media post removal. What do we know about that?
Yeah, the court issuing several major decisions this week. They could also extend into next week. In fact, 12 opinions left in this term, Paul and Alex. Paper opinions released at the courthouse in Washington just a few minutes before they're posted online. June Grosso, the host of Bloomberg Law, joining me now to go over some of these decisions. With respect to the Biden administration, their social media contacts, what was the decision?
So the decision, the complaint by a few Republican states and people was that indicative of how this term might end 6-3. So was wrong and they showed injured the plaintiffs at all these different, you know, the question is, and also
how this is going to play out before the election in terms of missing media.
Right. Also, there are two other cases that are sort of joined that are more important as far as social media is concerned, and those are the cases concerning the Texas and Florida laws, where they're trying to curtail the platforms into doing, you know, and it's another thing, like conservatives saying that, you know, they're being unfair to us and it's a question of free speech. So the dissent here was the three most conservative justices, Alito, Gorsuch, and Thomas.
How many more cases are going to be? Is that it for today?
There's one other case on public corruption, something that we haven't been following, but it continues the Supreme Court's skepticism of these public corruption laws.
All right. June Grasso, the host of Bloomberg Law, with me to break down some of these cases. The Supreme Court again backing the Biden administration on the social post media removal in terms of cases that go against the arguments.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. This Bloomberg Business Flash after yesterday's tech-heavy rally for the NASDAQ. Today, the major stock averages, they are mixed. The NASDAQ continues to add to its gains. The NASDAQ's 100 right now 35 points higher. That is up 0.2% at 19,735. If shares of NVIDIA after yesterday's advance, they're up another 0.8% at 127.16. And the S&P 500, 2 points lower right now, 54.66 on the index. The Dow Jones Industrial Average is down 145 points. That is a decline of about 0.4%. In the S&P 500, you have 8 of the 11 major industry groups. They are lower right now, being led by financials, the best performing group right now that belongs to consumer discretionary. And among the data that we got, the ECO data at the top of the hour, new home sales in the U.S. slumping in May as elevated prices, mortgage rates, they continue to challenge the U.S. housing market. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Alex.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney, we're live here at the very loud Bloomberg Invest Conference in Lower Manhattan. It's called the World Financial Center for those of us that were actually here back in the day, down in Lower Manhattan, which, by the way, is a great place. I'm going to plug it yet again. come down here in the warm weather with the kids and stuff. There's, you're right on the river, lots of cool restaurants, a lot of fun places for the kids to run around, big yachts there to look at. So it's a great part of the city that I think a lot of people kind of miss here. So NVIDIA, was that our drawdown the last,
That was it.
That was
3
it.
days.
Okay,
Yeah,
so now we're back up.
We had it.
All right.
And it's over now.
NVIDIA is up, taking up the NASDAQ, so there you go. Let's talk about these markets here and where we go. Clark Cheng, CEO and Chief Investment Officer, Merrimack Corporation. Clark is a Fuqua graduate at Duke University. So he's much younger than I am. But we both went to the business school.
I'll just sit back on this interview now.
Exactly. Hey, Clark, what do you feel about these markets here? How are you approaching them right here? Because we've got a Fed that presumably is going to be cutting rates at some time, I guess later rather than sooner. We've got decent earnings. How are you guys approaching it?
I think the Fed is thinking they're going to start cutting rates. That's what people think in September and stuff. I think every time we talk about this, it keeps getting delayed more and more. And I think this market is very dependent on what the Fed does and their timing of it. So growth is slowing down. Unemployment is slowly starting to increase. Things are heading in the right direction. Inflation is coming down. And it just depends on how the Fed reacts. If they react too quickly, I think we could go the wrong direction. If they react too slow, they go the other direction. So I think it's very conditional on how the Fed basically performs.
What I was struck with over the last day, listening to a lot of the Bloomberg Invest panels, is how little the Fed was really talked about. Like, it was a little bit here and there, but it was mostly about AI, how to invest, what the potentials are, and private credit, and sort of what do you do in that sector. As part of a family office, how do you guys look at the best investment thesis for AI?
AI is moving so fast that I don't think anyone has any idea what's going to happen with it. But it's going at an exponential pace. So we went from like PCs to the internet to mobile to cloud, and I think AI is going to be much faster. But I think the things that are going to change AI for this next generation, I don't think people can even comprehend. Like even in terms of making like entertainment and stuff like that, we don't need actors and actresses. Sora from OpenAI can generate video live, and I think this magic and secret is just in terms of how you prompt it. I think
my artist soul is slowly dying as you say that.
But it really is changing the world. I don't think people even understand. I think the danger of it is always going to be the deep fakes, the cybersecurity, all that stuff, because I think the hackers are much more innovative than the people defending against it, and they only have to win once. So I think that's the danger of it. I think people are starting to understand this, so I think we're starting to see dedicated AI models. I think Japan just invested in one for their country. I think India is looking at it too, because no one wants to be using the U.S. LLM model, basically. It's using U.S. data, and as a result, it reflects more of the U.S. population, the Western society, and stuff like that. To do that, run that in China is useless, because the Chinese population, they have so many restrictions on jaywalking or chewing gum or whatever that it just may not work over there. So I think AI is going to be, and I was out in Las Vegas last week, and he's a tech guy, and he's at an energy conference.
Yeah,
but
he was speaking with Edison International, which is the CEO that I've spoken to about power usage. They're based in California. So to that point, do you invest, though, in this thesis? Like, you're absolutely right. Like, everything you said makes complete sense. Do you make money off of that?
No, we can definitely make money off. I think it's changing so quickly. I think the problem is knowing who the winner is going to be. No matter what, NVIDIA is for now. Because everything they produce is sold out. And everyone's trying to get ahead. And if you're not buying the chips, you're not going to be on the forefront of this technology. So if they can keep the market share, that's fantastic. I think they have a moat around them with the software and the chip. But I think it's just a home run right now.
And what seems a little bit different, AI versus, say, the internet, for example, is the internet was a whole bunch of new companies, disruptors, whether it's Google or Facebook, disrupting the existing business models. Here it doesn't seem to be that way. It seems to be NVIDIA is the chip play. Maybe Microsoft's a software play. And it's these existing incumbents that are investing in and building up AI capabilities. I guess that's the way to play it.
It's all in the data. The data is oil. The data is what trains these models. The investments that you need in the infrastructure in terms of these data centers can only come from the largest companies, like, say, Microsoft. I think Microsoft and OpenAI have a project they're working on to build the biggest data center in the world to basically run AI. So I think it is going to be with those big winners that are out there. But if you're a small company, we see this a lot on the venture side. You develop something new, like, say, Midjourney, some of these video type of creation models. You're basically out innovated within 6 months when OpenAI releases Sora. So like it's happening at such a fast pace that if you're a startup and you don't have the capital and the resources, innovate faster than the big guys, your basic business model is basically gone in 6 months.
So you were on a panel that was titled Meeting the Needs of the Rising Generation. What does that mean? Is that like we don't have enough kids and everyone is going to get old and there's going to be a big fiscal deficit? Does that mean that it's going to be super isolationist? What does that mean?
I mean, we do have a demographic problem, I think, in the modern world where I think the population is declining. I think the people are getting older. What we were talking about earlier was more, there's an $84 trillion of wealth that's going to be transferred from the baby boomers towards the next 2 generations. It's going to happen over the next 20 years. And the question is how does it happen? What is this next generation like? What are their intentions? I think the generation that generated the wealth after World War II through housing and through the stock market, I mean their intention was clear. They were trying to generate wealth and have a good cost of living and stuff like that. I think the next generation is more idealistic, and they do want to help solve income inequality. They want to help solve climate impact, ESG stuff. I think the danger with that is the fact that if you're not focused on one goal and you have conditional goals where this is the best investment relative to climate, it gets hard to measure how you're actually performing. And as a psychologist, we really wanted to keep things simple. We want to have one goal. You could have another goal for a different part of your business, like say at the foundation, but to combine the two into one, I think you really never know how you're doing.
So from an investment perspective, do you have that in your mind, ESG, and let's not even use those letters because they become toxic, I guess. It just is that part of your investment outlook, or are you just there focused on generating the best returns for your client?
We're here to generate returns, and then we have another side, the foundation side, that does all the charitable stuff.
Yep.
So we have 2 distinct goals and 2 separate parts of our businesses, but we try not to combine the 2 into one.
Then I guess the question then becomes, how do you think of, say, the deglobalization part? Because you get the